Welcome everyone. Are you curious about the exciting world of the stock market or futures trading? Are you interested in learning about the financial markets to get started investing, diversifying your portfolio to boost your earnings potential? Either way, you've landed in the right place. My name is Yu. Why Yu? A professional trader with many years of experience under my belt. I've been navigating the tumultuous waves of the financial markets, particularly the futures, but also stocks, as well as options on stocks. In today's discussion, we will be taking a look at futures trading strategies versus stock options trading strategies. We will be doing a comparison for new investors or seasoned investors who would just like a refresher. We will do a deep dive on the comparison between investing or speculating with futures or investing or speculating via stock options. We'll take a look at some comparative advantages and how they might suit different investors based on their personalities, their risks and reward tolerances, etc.
Futures trading strategies versus stock options trading strategies. A comprehensive comparison for investors. The world of trading offers a plethora of strategies, each with its unique characteristics, risks, and benefits. Among the most popular are futures trading strategies and stock options trading strategies. While both can be lucrative, they cater to different investor needs, preferences, and risk tolerances. In this discussion, our aim is to provide a comprehensive comparison between these two trading approaches, helping upcoming traders and seasoned investors alike make more informed decisions based on their individual investment goals. As we delve deeper into this exploration of futures trading and stock options strategies, we're set to uncover the intricate layers that define their market dynamics. Imagine navigating a complex financial landscape where each decision can unlock new opportunities or present unforeseen challenges. This is the essence of what we will unravel together. Our journey will take us through the nuanced realms of risk and reward, where we'll dissect how these two strategies differ fundamentally not just in their mechanics, but in their very approach to market engagement. This exploration is more than a mere comparison of tools. It's an insightful voyage into the core of financial strategy making. As we delve into the world of futures trading, we'll uncover how this approach magnifies both gains and losses through leverage, a double-edged sword that demands respect and careful handling. We'll explore various futures strategies from the straightforward to the complex, including popular techniques like trend following, hedging, and spread trading, each revealing how futures traders capitalize on market movements and manage risks. Simultaneously, our exploration of stock options will reveal a universe rich with strategic possibilities. We'll examine a range of options strategies, from basic tactics like buying calls and puts to more sophisticated maneuvers such as iron condors and butterflies. These strategies showcase the flexibility of stock options, allowing traders to profit in up, down, or sideways markets. We will navigate through how options can be used not only for speculative gains, but also for income generation and risk management, adapting to an investor's market sentiment and risk appetite. By understanding the foundational elements of both futures and stock options, we aim to provide a balanced view that appreciates the strengths and acknowledges the limitations of each approach. We'll also delve into real-life applications of these strategies, illustrating how theoretical concepts are put into action in the dynamic world of trading. This comprehensive approach ensures that by the end of our discussion, you will have a deeper understanding of both futures trading and stock option strategies. Whether you are looking to diversify your portfolio, hedge against market volatility, or seek new avenues for investment growth, this journey promises to equip you with the knowledge and insights necessary to navigate the complexities of these two powerful trading domains. But our discussion goes beyond just understanding the technicalities. We aim to align these strategies with your personal investment narratives. Whether you're an aspiring trader looking to make your first foray into the markets or a seasoned investor seeking to refine your portfolio, the insights offered here are tailored to provide clarity and direction. Intrigue lies in the details, and as we progress, expect to encounter real-world scenarios, strategic comparisons, and expert insights that bring to life the applications of these strategies. This isn't just a comparison, it's a pathway to discovering your trading identity in the world of futures and options. So, stay with us as we embark on this enlightening journey. By the end of our discussion, you'll be equipped not only with knowledge, but with a perspective that could redefine your approach to trading and investing. Let's dive into the world of futures and stock options trading strategies and unravel the secrets to mastering these powerful financial instruments. Understanding the basics about futures trading and stock options trading. Before delving into the specifics, it's crucial to understand the fundamental differences between futures and stock options. Let's take some time to discuss the basics of futures trading. Futures trading involves contracts obligating the purchase or sale of assets at a predetermined future date and price. These contracts are standardized and traded on exchanges, covering a variety of assets such as commodities, currencies, and indexes. Mark-to-market is a critical accounting process used in futures trading, where the value of open futures contracts is adjusted to reflect their current market value at the end of each trading day. This adjustment is vital as it ensures that the gains and losses from futures positions are accurately reflected and realized daily. Each day, futures exchanges determine a settlement price for all futures contracts, and the accounts of all traders holding positions in these contracts are then adjusted to this settlement price. If the market moves in favor of a trader, the profits are added to their margin account, while losses are deducted if the market moves against them. This process ensures that all gains and losses are realized in real time, maintaining the integrity of the futures market. The mark-to-market mechanism has several important implications for futures traders. Unlike options, where the outcome is realized at expiration, futures trading involves a continuous cycle of gains and losses. This can lead to daily cash flow requirements if a position moves against a trader, as they may need to top up their margin account to meet maintenance margin requirements. The daily settlement process of mark-to-market makes risk management in futures trading dynamic, requiring traders to be vigilant about market movements and have a clear strategy for managing positions on a day-to-day basis. Due to the potential for daily margin calls, futures traders need to ensure they have sufficient liquidity to maintain their positions, contrasting with options trading where the premium paid upfront is the maximum loss for buyers. While futures can be used for long-term hedging, the mark-to-market process can impart a short-term focus to trading, as traders need to be prepared for the possibility of frequent adjustments to their margin accounts. Mark-to-market can amplify the impact of market volatility on traders' accounts. and significant market swings can lead to substantial margin calls, requiring traders to closely monitor their positions and market trends. In summary, understanding and managing the mark-to-market process is vital for success in futures trading. It differentiates futures from other derivative instruments like stock options by introducing a unique set of challenges and considerations. As a futures trader, mastering the intricacies of mark-to-market is as crucial as understanding leverage or the underlying asset itself. It's a core component that shapes the daily life of a futures trader, influencing everything from trade strategy to liquidity management. On the other hand, let's examine stock options trading. Let's take a little time to contrast the mark-to-market or daily settlement of the futures market versus the settlement used in the stock market. The settlement used for stocks and options on stocks is called T+2. The T+2 settlement cycle refers to the time frame within which securities transactions must be settled after a trade is executed. This term stands for trade date plus 2 business days. When you buy or sell stocks, the actual exchange of money and shares doesn't occur instantly. Instead, it follows this T+2 schedule. The trade date, often abbreviated as T, is the day when the trade is executed. This means it's the day when the buyer agrees to buy and the seller agrees to sell a security. The settlement date, which occurs 2 business days after the trade date, is when the actual settlement of the transaction takes place. This delay allows the parties involved time to arrange for the transfer of cash and securities. There are several critical reasons for the T+2 system. It helps manage risk by providing time to verify the details of the trade and ensure all parties have the necessary funds and securities. This process mitigates the risk of default by either party. The settlement period also allows for the processing of a large volume of transactions and the resolution of any discrepancies that might arise. T+2 is a standard adopted in global markets, helping to synchronize and streamline international transactions. The shift from older settlement cycles like T+3 to T+2 was made possible by advancements in technology and changes in regulatory practices. These changes were aimed at reducing risk and improving market efficiency. Unlike futures markets, where mark-to-market involves daily settling of gains and losses, stock market trades are settled in a lump sum after a couple of days. This difference reflects the distinct nature of these markets and their respective risk profiles. As we can hear from the previous discussion, the T+2 settlement cycle in the stock market is crucial for ensuring the smooth, efficient, and secure processing of securities transactions. It provides a standardized time frame for the settlement of trades, reducing risks and enhancing operational and regulatory compliance. Understanding T+2 is essential for stock market participants as it influences the timing of cash and security flows and impacts liquidity management. Understanding the differences between these two mechanisms is crucial for grasping how financial markets operate and manage risks. The key difference between the T+2 settlement cycle in stock trading and the mark-to-market process in futures trading lies in the timing and nature of the settlement of transactions. In the stock market, the T+2 settlement cycle dictates that the final transfer of stocks and the corresponding payment occurs 2 business days after the trade is executed. This cycle allows time for verifying trade details and arranging the necessary funds and securities. It is a post-trade process where the actual exchange of assets happens at the end of the settlement period, reflecting the trade's value at the time of the transaction. On the other hand, the mark-to-market process in futures trading is a daily reconciliation of account balances to reflect current market values. Every day, the value of open futures contracts is adjusted to the market's closing prices. This continuous adjustment ensures that gains and losses from futures positions are realized and recorded daily. If the market moves favorably, profits are added to the trader's margin account. Conversely, losses are deducted if the market moves unfavorably. This process not only ensures real-time reflection of gains and losses, but also necessitates that traders maintain adequate liquidity to meet daily margin requirements. While the T+2 settlement provides a brief buffer for stock traders to arrange their finances, mark-to-market in futures trading demands constant vigilance and immediate financial response to market movements. The T+2 settlement cycle is more about finalizing a transaction made at a specific past point in time. In contrast, mark-to-market is about continuously adjusting to the market's present conditions, making futures trading inherently more responsive to daily market fluctuations. These different approaches reflect the distinct nature and risks inherent in stock and futures trading. The T+2 settlement cycle caters to the structure of the stock market, where trades are based on ownership transfer. In contrast, the mark-to-market method suits the futures market, where contracts are based on speculations about future asset prices. Understanding these mechanisms is vital for market participants, as they directly impact trading strategies, risk management, and capital requirements. Stock options trading offers a distinctive approach within the financial markets. It allows traders the right to engage in the purchase or sale of a stock, depending on the type of option they hold. With call options, traders have the right to buy a stock at a price that is agreed upon beforehand. Similarly, put options grant traders the right to sell a stock at a predetermined price. These rights can be exercised within a specified time frame or on an exact date. This element of choice sets stock options apart from the more immediate nature of stock trading transactions and the daily adjustments to valuation that are characteristic of futures trading. When participating in options trading, traders are afforded a significant degree of flexibility. They can decide whether to exercise their options based on the current market conditions and aligned with their individual investment strategies. This flexibility is a stark contrast to the rigid settlement period seen in stock trading and the continuous mark-to-market process found in futures trading. The diverse uses of options include hedging against potential market risks, generating income by collecting premiums, and engaging in speculative activities based on predictions about market movements. An in-depth understanding of stock options and their strategic application is crucial in the realm of modern investing and trading. These options provide a tool of great versatility, fitting into a variety of investment strategies. They offer a level of control and a means of mitigating risk that is typically absent in straightforward stock trading or in the fast-paced and highly variable futures market. This diversification across strategies and financial instruments underlines the complexity and multifaceted nature of financial markets. It opens up a broad array of opportunities for investors and traders to manage risks and explore potential avenues for returns. Stock options trading offers the right, but not the obligation, to buy call option or sell put option a stock at an agreed upon price within a certain period or on a specific date. Options are used for hedging, income generation, or speculative purposes. Further discussing the world of stock options trading. In further discussing the world of stock options trading, it's essential for any investor aiming to navigate this market successfully to understand the Greeks. Among these Greeks, theta stands out as a crucial element because of its direct impact on the value of options over time. Known as the time decay factor, theta represents the rate at which an option's value erodes as the expiration date approaches. This consistent and inevitable passage of time can significantly influence an investor's strategy, at times turning potential gains into losses or vice versa. Theta is often described as the silent player in the options market, steadily and relentlessly working in the background. Each day that passes brings an option closer to its expiration date, and with each tick of the clock, theta chips away at the option's extrinsic value. This decay is not linear. It accelerates as the expiration date nears, making theta a critical factor for short-term option traders. For option sellers, otherwise known as options writers, theta can be an ally. As time passes, the options they have sold decrease in value, assuming other factors like the stock price and volatility remain constant. This decay works in their favor as it increases the likelihood of the options expiring worthless, allowing them to keep the entire premium received when they sold the options. Conversely, for option buyers, theta is a persistent adversary. The erosion of the option's time value means they are fighting a ticking clock, especially in strategies that require significant price movement in the underlying stock. For these traders, not only does the stock need to move in the desired direction, but it also needs to do so quickly enough to outpace the loss of value due to time decay. Understanding theta's impact is vital for strategic planning in options trading. Traders employing strategies like long calls or puts need to be acutely aware of the time decay factor. They may need to adjust their approach, perhaps by choosing options with more extended expiration dates to mitigate theta's impact, albeit at a higher upfront cost due to a higher extrinsic value. On the other hand, strategies like writing covered calls or selling puts can benefit from theta. Here, the goal is often to earn income through the premium, with a favorable position on theta decay. The trader's aim is for the option to expire worthless, allowing them to retain the full premium while minimizing the risk of the option being exercised. For traders, the key to harnessing theta lies in a deep understanding of their own trading timelines and risk tolerance. Short-term traders need to account for theta's rapid acceleration as expiration nears, while long-term traders might focus more on intrinsic value and less on time decay. In summary, theta's role in options trading is a powerful reminder of the impact of time in financial markets. By factoring in theta alongside other Greeks like delta, gamma, and vega, traders can develop more nuanced and informed strategies that align with their market outlook and investment goals. Whether it's exploiting theta decay in selling strategies or mitigating its effects in buying strategies, a solid grasp of this Greek is essential for anyone looking to master the art of options trading. Strategic differences between speculating with trading futures versus stock options. Based on the investment vehicle, there are different risks and rewards. Futures trading is often considered riskier due to the obligatory nature of contracts and the leverage involved. However, this also means higher potential returns. Stock options, meanwhile, typically involve less risk, especially for buyers, and provide more strategic versatility, but usually require more sophisticated market knowledge. The risk and reward dynamics of futures trading versus stock options trading. In discussing futures trading, it's important to note that futures contracts often involve significant leverage, creating a high risk, high reward scenario. Futures traders are obligated to fulfill the contract regardless of market conditions, leading to potential substantial losses or significant gains. The leverage in futures trading magnifies results, serving as a double-edged sword. This heightened risk profile requires a solid understanding of the market and a robust risk management strategy. On the other hand, stock options trading typically involves lower risk levels, especially for option buyers. The maximum risk is generally limited to the premium paid for the option, making it more accessible for risk-averse traders or those new to the markets. However, it requires a more sophisticated understanding of various factors, including how different option strategies capitalize on diverse market scenarios. Options trading offers strategic versatility, allowing traders to profit from market movements, lack of movement, or even from volatility levels. Comparatively, futures trading provides a straightforward buy and sell approach with the potential for high returns, but its significant leverage can amplify losses, necessitating careful risk consideration. Stock options, while often presenting lower leverage risk and limited maximum loss, require complexity in strategy and understanding, which can be challenging for new investors. Market direction and leverage affects both stock options and futures trading differently. Futures traders need to accurately predict the market direction and often utilize higher leverage, amplifying both gains and losses. In contrast, options trading allows for strategies that can profit from market direction, uncertainty, or stability, with different leverage effects. A comparative analysis on how market direction and leverage affects futures trader and options traders. Futures traders must have a keen sense of market direction. Their success often hinges on the ability to predict market movements accurately and to leverage their positions appropriately. The use of leverage in futures can exponentially increase both profits and losses. Therefore, understanding the underlying assets, market conditions, and trends becomes crucial. This high-stakes environment makes futures trading more suitable for experienced traders who can navigate rapid market changes and understand the implications of leverage. Options trading provides more diverse strategies in terms of market direction. Traders can employ various strategies that benefit from different market conditions, including stable, bullish, bearish, or highly volatile markets. The leverage effect in options is different from futures. For instance, buying options can offer high leverage with limited downside risks, limited to the premium paid, while writing options can involve significant risk, especially if done naked, meaning without owning the underlying asset. How does liquidity and expiration affect stock options versus futures trading? Futures contracts generally offer high liquidity and have a set expiration date, leading to a more short-term, focused trading approach. Options also have expiration dates, but the variety of strike prices and types, such as the relatively common American or the ever-present but uncommon European options, offer more flexibility to the trader. Liquidity and expirations effects on stock options trading versus futures trading. Investing using futures trading strategies involves understanding the dynamics of futures contracts, which are known for their high liquidity. This is particularly true in popular markets like oil, gold, or indices. The high liquidity of these markets facilitates easier entry and exit from trading positions. Additionally, futures contracts come with set expiration dates, necessitating traders to adopt a more short-term and focused trading approach. As expiration dates approach, traders need to be acutely aware of these timelines. They also need to consider the potential for rolling over contracts if they wish to maintain their position beyond the expiration date. In contrast, strategies employed by stock options speculators involve dealing with expiration dates as well, but here, the diversity of strike prices and the choice between American and European styles afford more strategic flexibility. Options traders can choose from a broad spectrum of expiration dates, ranging from a few days to several months or even years. This range allows them to align their trading strategies with various trading goals and timeframes. The flexibility in options trading enables traders to tailor their strategies to specific market views and desired timeframes. However, with the varying expiration dates, options traders must also be particularly mindful of time decay, also known as theta, especially as the option approaches its expiration date. This aspect of options trading requires careful planning and strategy adjustment to mitigate the effects of time decay on the value of the options. Strategic considerations in choosing your trading path. Both futures and stock options trading come with their unique set of strategic considerations. Futures trading offers a straightforward, high-leverage approach for those who can accurately predict market direction. In contrast, stock options trading provides a range of strategies that cater to various market conditions and risk appetites. The choice between the two should be based on individual trading goals, market knowledge, risk tolerance, and the preferred level of strategic complexity. As with any trading decision, thorough research, continuous learning, and sound risk management are key to success in navigating the intricacies of futures and stock options trading. Let's examine the investment goals and trading style investing using futures trading and stock options trading using a few different metrics. Let's talk about speculating or investing based on trading futures versus speculating or investing with stock options. Let's examine how they compare based on income generation versus speculation. Options trading provides diverse strategies like covered calls for income generation or protective puts for hedging. Futures are more suited for speculation and hedging against price movements in commodities or currencies. Investment goals and trading style in stock options trading. Let's talk about income generation and hedging using options. Stock options trading offers a variety of strategies that cater to different investment goals, particularly income generation and hedging. Strategies like writing covered calls allow investors to generate regular income from their stock holdings, turning them into productive assets even in stagnant market conditions. Similarly, protective puts can be used effectively for hedging, providing insurance against potential losses in stock holdings. These strategies make options trading appealing for investors who prefer steady income or wish to protect their portfolios against downside risks. Let's also examine long-term strategic plays using stock options. Options trading is also well suited for investors with a long-term orientation. By using strategies based on market forecasts or company performance, such as buying long-term call options, often called LEAPs, less commonly known as long-term equity anticipation securities, on stocks expected to appreciate, investors can leverage their market predictions with a lower upfront capital commitment compared to buying the stock outright. This aspect of options trading aligns with the goals of investors who base their decisions on fundamental analysis and long-term market trends. Trading futures versus stock options, let's examine how they compare based on long-term versus short-term orientation. Options can be used for longer-term strategic plays based on market forecasts or company performance, whereas futures trading is typically more short-term due to the nature of the contracts. Investment goals and trading style in futures trading. Futures trading is well suited for speculation in commodities and currencies due to its inherent leverage and contract structure. Traders can take substantial positions with a relatively small capital outlay, which can lead to significant gains if the market moves favorably. However, this also brings increased risk, making futures more suitable for those comfortable with high-risk scenarios. Futures are also key in hedging against price movements in various assets. For example, businesses reliant on certain commodities can use futures to lock in prices, reducing the risk of price fluctuations. Futures contracts typically have a short-term nature because of their set expiration dates. This attribute makes futures trading appealing to traders with a short-term market focus, such as day traders or swing traders. These traders often use technical analysis or other speculative strategies to capitalize on market trends and fluctuations over short periods. The liquidity and high leverage in futures markets enable these traders to leverage even small market movements, potentially leading to significant profits or losses. In conclusion, stock options and futures trading cater to different investment goals and trading styles. Options trading, with its strategies for income generation, hedging, and long-term market plays, is well suited for investors seeking flexibility and risk management tools. Futures trading, on the other hand, appeals to those with a short-term market focus and a higher risk tolerance, offering opportunities for speculation and hedging in a variety of assets. Understanding these differences is crucial for investors and traders in aligning their trading strategies with their individual investment objectives and risk preferences. Let's talk about the costs to speculate in the two markets. What are the capital requirements and costs to speculate with futures versus stock options? The initial capital requirement and cost structures vary significantly. Futures trading generally requires a higher initial margin and comes with daily settlement risks, as well as maintenance margin requirements. Whereas stock options trading can be initiated with a lower capital outlay premium paid, offering a higher risk-reward ratio for the capital invested. Let's start by discussing the capital requirements and costs to invest using futures trading. Futures trading often has higher margin requirements because it typically involves higher initial capital due to margin needs. Traders are required to deposit a margin, which is typically a fraction of the total contract value, to hold a position in futures. This margin serves as a form of security against potential losses. The need for a margin deposit, which can be a significant portion of the contract's value, can make futures trading less accessible for traders with limited capital. Futures contracts are subject to daily settlement, meaning the profit or loss on the contract is adjusted at the end of each trading day. This process, known as mark-to-market, can lead to daily margin calls if the market moves against the trader's position. Traders must be prepared to meet these margin calls, which can require additional capital and add to the overall cost of trading futures. While leverage in futures trading allows traders to control large contract values with a relatively small amount of capital, it also amplifies both gains and losses. This can lead to significant financial risks and additional costs if market movements necessitate frequent margin adjustments. In contrast to futures, stock options trading can be initiated with a lower capital outlay. When buying options, traders pay a premium, which is the cost of the option. This premium is typically much less than the cost of purchasing the underlying stock outright, making options trading more accessible for smaller investors or those looking to reduce upfront investment. The premium paid for buying an option represents the maximum risk for the buyer. This means that the potential loss is limited and known upfront, offering a more favorable risk-reward ratio, especially for conservative investors or those new to trading. The ability to define risk clearly is a significant advantage for options traders. While the initial capital requirement may be lower in options trading, implementing more complex strategies can involve additional costs. These include brokerage fees, especially if the strategy involves multiple transactions, and potential costs associated with time decay, otherwise known as theta, particularly for options writers or those holding long-term option positions. The choice between futures and stock options trading should consider both the initial capital requirement and the ongoing costs associated with each type of trading. Futures trading, while offering the potential for substantial gains, requires higher capital investment and comes with the risk of significant additional costs due to daily settlements and margin requirements. In contrast, stock options trading generally allows market participation with a lower upfront investment and a more controlled risk profile, albeit sometimes at the cost of additional complexity and potential time decay. Investors and traders need to weigh these factors against their investment goals, capital availability, and risk tolerance to choose the most suitable trading approach. The intricate tapestry of futures and stock options trading, each with its unique strategies and market approaches, offers a vast landscape for investors to navigate. These two distinct realms cater to diverse trader profiles. Futures trading resonates with those seeking a direct, high-leverage approach to market direction, while stock options appeal to investors desiring strategic diversity and alignment with various market perspectives and risk profiles. The decision to venture into either of these realms hinges not only on an investor's financial aspirations and market acumen, but also on their appetite for risk and strategic preference. As we transition from these concluding thoughts, it's clear that understanding the nuances of both futures and stock options trading is not just about choosing one over the other. Instead, it's about recognizing the unique opportunities each presents and how they can be used in tandem or independently to achieve a well-balanced, robust investment portfolio. In the next section, we delve deeper into these markets. We'll unpack the intricacies of each, exploring how they can be harnessed effectively to meet a range of investment goals and styles. From the adrenaline-fueled world of futures trading to the strategic depths of stock options, we invite you to join us on this journey of discovery. Whether you're a seasoned trader or just starting, This exploration aims to enrich your understanding and guide your decisions in these dynamic segments of the financial markets. The financial landscape offers distinct opportunities through the realms of futures and stock options trading, each with its own set of strategies and approaches. These two trading forms are critical for investors to understand, as they can significantly shape a well-rounded investment portfolio that resonates with personal trading styles and objectives. Futures trading embraces high leverage and direct market engagement. Futures trading emerges as a top choice for those seeking a direct approach with potential for significant market impact. This trading method is defined by several characteristics. Let's discuss some of the most important characteristics. In futures trading, leverage plays a central and crucial role. The utilization of leverage allows traders to exert significant control over a large underlying asset with a comparatively modest capital investment. This aspect of leverage can lead to substantial gains, but it also escalates the potential for significant losses. It highlights the crucial importance of adept risk management in futures trading. Understanding and effectively managing leverage is key to success in this trading domain. Futures traders often engage in what is known as directional trading. This type of trading typically involves taking positions based on anticipated movements in specific market directions. Success in directional trading hinges on an in-depth understanding of market trends and the ability to swiftly adapt to changes in the market. Traders must stay informed and responsive to market dynamics to capitalize on these anticipated movements. Additionally, futures trading usually attracts individuals with a short-term investment focus. The specific nature of futures contracts, combined with the notable impact of leverage, makes it particularly appealing to traders who aim to capitalize on quick market movements. These traders are often looking to profit from short-term fluctuations in the market, aligning their trading strategies to benefit from these rapid changes. Beyond the realm of speculation, futures also serve an important role in hedging against price movements in various assets. This function of futures contracts is particularly beneficial for businesses or investors who have exposure to commodities or currency risks. By using futures for hedging, they can effectively manage and mitigate the risks associated with price fluctuations in these markets. This hedging aspect of futures trading provides a critical tool for those looking to protect themselves against adverse market movements, making futures a versatile instrument not just for speculation, but also for comprehensive risk management. Stock options trading offers diverse strategies and flexible market approaches. In contrast, stock options trading presents a more varied landscape of strategies, appealing to a broad range of market views and risk appetites. Options trading includes a wide variety of strategies tailored for different market conditions. This richness in strategies allows traders to utilize methods like covered calls for generating income, protective puts for hedging purposes, and various spread strategies to take advantage of different market sentiments, whether bullish, bearish, or neutral. These diverse strategies enable traders to adapt and profit under various market scenarios. A key feature of stock options trading is the defined risk profiles it offers, especially for buyers. In stock options trading, the level of risk involved is typically lower. The maximum risk for option buyers is usually limited to the premium paid for the option. This limitation provides a more controlled way for traders to engage in speculation or to hedge their other investments. Moreover, stock options trading offers significant flexibility in responding to market views. Traders in the options market can profit not just from direct market movements, but also from situations where the market is stable or even from different levels of market volatility. This flexibility allows traders to tailor their strategies to align with a wide range of market predictions and volatility scenarios. Additionally, unlike futures trading, stock options trading can be used for longer-term market plays. This is possible because options strategies can be based on broader market forecasts or the performance of individual stocks over a longer period. This aspect of stock options trading provides a different type of investment opportunity compared to the typically shorter-term nature of futures trading. Traders can thus leverage stock options for more extended market strategies, broadening their investment scope beyond the immediate and often more volatile futures market. Making the informed choice aligns with individual investment goals and capabilities. The decision to engage in futures or stock options trading depends on the investor's personal financial goals, depth of market knowledge, risk tolerance, and investment timeframe. Futures trading, with its straightforward approach and significant leverage, may suit those comfortable with taking substantial market directional risks. In contrast, stock options offer strategic diversity and defined risk, appealing to those seeking versatile strategies and controlled risk exposure. Education and diligence are key to success in both futures and stock options trading. Therefore, success in both futures and stock options trading is grounded in thorough market research, ongoing education, and diligent risk management. Navigating these markets requires not only a grasp of their respective mechanics, but also a commitment to staying updated on market conditions and regulatory developments. Whether opting for futures for their leverage and directness or options for their strategic depth and risk control, informed decision-making is the cornerstone of thriving in these dynamic financial arenas. In the complex and multifaceted world of financial markets, futures and stock options trading stand out as distinct entities, each offering its own unique array of strategies, challenges, and opportunities. Having established a solid understanding of their fundamental differences and primary characteristics, we now transition into a critical exploration of the specific trading techniques and strategies that drive success in these two diverse realms. Futures and stock options trading are not just about selecting the right instruments. They are about mastering the art of strategically wielding these tools to align with individual trading goals and styles. In this comprehensive segment, we will delve into a variety of techniques and strategies uniquely suited to each trading form, enriched with real-world examples, case studies, and expert insights. Our goal is to provide a nuanced understanding of how these instruments can be effectively utilized across different market scenarios. Futures trading emphasis on leveraging market movements and managing risks. In futures trading, the strategies often revolve around leveraging market movements, hedging against potential risks, and seizing short-term opportunities. We will explore how futures traders employ methods like day trading, swing trading, and position trading to navigate market volatility and trends. These strategies will be brought to life with practical examples, showcasing how they play out in real market scenarios and are influenced by individual traders' risk tolerance and investment goals. Stock options trading might be more geared towards generating income and speculating with flexibility. Turning to the world of stock options, the strategies take on a distinct focus. Here, traders engage in income generation, market speculation, and meticulous risk management. We will examine how options traders use strategies like buying calls and puts, writing covered calls, and crafting various spread strategies to maneuver through diverse market conditions. The ground truth about and investing is personal trading considerations, aligning strategies with individual profiles. As we traverse through these specific strategies, we recognize the significance of personal trading considerations. The effectiveness of these strategies is not solely determined by the instruments or market conditions, but is deeply intertwined with the personal attributes of the trader. This includes individual goals, personality, risk management strategies, risk tolerance, and investment time horizons. Whether you are a seasoned trader refining your approach or a novice developing your strategy repertoire, this exploration aims to provide valuable insights into the dynamic worlds of futures and stock options trading. By understanding the personal dimension of trading, we can develop approaches that are not only effective in the markets, but also resonate with individual investment philosophies and lifestyles. Our journey through the specific techniques and strategies of futures and stock options trading equips you with both the knowledge and practical insights necessary for successful navigation in these markets. This exploration is more than theoretical. It's about applying strategies in ways that align with your unique trading philosophy and objectives, setting the stage for a more informed and personalized approach to the diverse world of financial trading. As we conclude this foundational overview, we stand at the threshold of a more detailed journey into the world of futures and stock options trading. Equipped with both the foundational knowledge and practical insights, we now prepare to delve deeper into the specifics of each investment type. This next phase of our exploration will not only present an overview of the distinct strategies and techniques inherent to each market, but will also illuminate the advantages and challenges associated with them. We will embark on a comprehensive examination of the various strategies unique to futures trading, delving into techniques that have proven effective in leveraging market trends and managing risks. From the aggressive maneuvers of day trading to the more measured approaches of swing and position trading, we'll dissect these methods to reveal their potential impacts on investment outcomes. Simultaneously, our focus will also shift to the intricate world of stock options. Here, we will dissect strategies ranging from the basic to the complex, from buying calls and puts for speculative gains to employing sophisticated options, spreads for income generation, and risk mitigation. Each strategy will be scrutinized not just for its potential benefits, but also for its inherent risks and limitations. This exploration aims to provide you with a balanced perspective, one that recognizes the diversity of strategies within each trading realm and appreciates their suitability under varying market conditions. Whether you are inclined towards the rapid pace of futures markets or the strategic depth of stock options, understanding the pros and cons of each approach is crucial. As we transition into this detailed analysis, remember that the ultimate goal is not only to acquire knowledge, but to apply it effectively. The strategies and techniques we will explore are tools in your financial arsenal, and their effectiveness greatly depends on how well they align with your trading philosophy, risk tolerance, and market perspective. Let's move forward with an open mind and a keen eye, ready to absorb and apply the insights that will shape your trading strategies in the futures and stock options markets. As we conclude our balanced perspective on the varied strategies within the realms of futures and stock options trading, It's clear that understanding the advantages and challenges of each approach is crucial for every investor. Whether drawn to the fast-paced environment of futures markets or the strategic intricacies of stock options, the key to success lies in a deep comprehension of the strategies employed. We now stand at the cusp of a more detailed and practical phase of our exploration. In the upcoming section, we will delve into specific trading strategies and techniques within both futures and stock options trading. Our analysis will be structured around 5 critical criteria that are essential for a comprehensive understanding of each strategy. Our detailed analysis begins by outlining the primary objectives of various trading strategies within the realms of futures and stock options. This crucial step helps in aligning each strategy with broader investment goals such as income generation, capital appreciation, hedging, or speculation in either market. Understanding these objectives is key to choosing the right strategy for your needs. We will then assess how each strategy within futures and stock options trading performs under a variety of market conditions. This analysis is instrumental in understanding which strategies are best suited for volatile markets, as opposed to those more effective in stable or directional markets. It aids you in selecting the right strategy and some appropriate finance instruments at the right time based on market conditions. Our exploration will include a comprehensive examination of the risk profiles for each strategy in both futures and stock options trading. This will involve discussing the maximum potential losses and the risks related to movements in the underlying asset. Understanding these risk profiles facilitates a better alignment of each strategy with your personal risk tolerance, ensuring that your chosen strategies fit within your risk parameters. We will also delve into the potential rewards that each strategy in futures and stock options trading can offer. Evaluating the best case scenarios and average expected returns gives you a realistic understanding of what you might gain from each approach. This step is crucial in setting expectations and understanding the potential outcomes of different trading strategies. Finally, we will provide a detailed guide on implementing strategies effectively in both futures and stock options trading. This guide will cover the necessary steps such as choosing appropriate strike prices and expiration dates. It will also highlight special considerations or skills needed, like technical analysis, for optimal trading decisions, ensuring that you have a comprehensive understanding of how to execute these strategies in the market. Through this structured and detailed approach, we aim to provide you with an in-depth understanding of various strategies in futures and stock options trading, equipping you with the knowledge and tools to navigate these complex markets successfully. As we move forward into this detailed analysis, keep an open mind and be ready to absorb and apply the insights that will shape and refine your trading strategies in the dynamic worlds of futures and stock options trading. Let's embark on this insightful journey, equipped to navigate the complexities and seize the opportunities that these diverse financial markets offer. Let's start discussing some strategies that are suitable for futures day trading. In trend following strategies in futures trading, traders identify the direction of the market trend and make trades in that direction. This might involve buying in an uptrend or selling in a downtrend, often using technical indicators to identify these trends. What is the primary objective of trend following strategies in futures trading? The primary objective of trend following strategies in futures trading is to capitalize on market trends. These strategies aim to identify and follow significant directional movements in the market, whether upward or downward, to generate profits. The primary goal of trend following strategies in futures trading is to capitalize on sustained market movements. Traders aim to identify and follow significant market trends, buying in uptrends and selling in downtrends. This strategy is often chosen by traders seeking capital appreciation through market momentum. How do trend following strategies adapt to different market conditions? Trend following strategies are ideally suited for trending markets. They adapt by focusing on long positions in rising markets and short positions in declining markets. However, these strategies may face challenges in sideways or highly volatile markets where clear trends are less apparent. Trend following strategies are most effective in markets that exhibit clear and sustained trends, whether upward or downward. They are particularly well suited to volatile markets where trends are more pronounced and can be leveraged for significant gains. These strategies may not perform as well in sideways or highly erratic markets where clear trends are harder to identify. What is the risk profile associated with trend following strategies? The risk profile of trend following strategies involves managing the risks of trend reversals. These strategies may be exposed to potential losses if a market trend unexpectedly changes direction. Effective risk management techniques, such as stop-loss orders, are crucial to mitigate these risks. While trend following can be profitable, it comes with the risk of sudden trend reversals, which can lead to losses, especially if the trader is unable to exit the position promptly. The maximum potential loss can be significant if market trends shift unexpectedly and positions are not managed properly. Traders need to have a clear risk management strategy, often using stop-loss orders to mitigate these risks. What potential rewards can be expected from trend-following strategies? The potential rewards from trend-following strategies come from gains achieved through sustained market movements. By riding long trends, these strategies can accumulate significant profits, especially in markets that exhibit strong and prolonged directional trends. The reward potential of trend following in futures trading lies in capturing the gains from large, sustained market movements. The best case scenario is entering a trade early in a trend and riding it to its culmination. However, traders should also have realistic expectations, as not every identified trend will result in large profits, and the average expected return may vary based on market conditions and the trader's timing. What are the key steps and considerations in implementing trend following strategies in futures trading? Key steps and considerations in implementing trend following strategies include identifying trends and determining optimal entry or exit points. This involves analyzing market data to spot emerging trends, deciding when to enter and exit trades, and continuously monitoring market conditions to adjust positions as needed. To implement a trend following strategy, traders typically use technical analysis to identify potential trends. Key steps include choosing the right futures contract based on market analysis, using technical indicators like moving averages, moving average convergence divergence, or relative strength index to identify potential trends, determining entry points when a trend is confirmed and setting exit points or stop-loss orders to manage risks, monitoring the position closely and being prepared to exit if the trend shows signs of reversing. Traders also need to consider factors like contract expiry and rollover when trading futures. Scalping strategies in futures trading. This strategy involves making numerous trades to profit from small price changes. Scalpers aim to enter and exit trades quickly, capitalizing on minor market movements throughout the trading day. What is the strategic goal of scalping strategies in the context of futures trading? The strategic goal of scalping strategies in futures trading is capitalizing on small price changes. Scalpers aim to make quick profits from very short-term trades, exploiting minor price movements that occur frequently throughout a trading day. The primary goal of scalping in futures trading is to generate profits from small price movements. Scalpers focus on short-term trading, aiming to enter and exit trades quickly throughout the trading day. This strategy is typically oriented towards income generation through frequent, small gains rather than long-term capital appreciation. How do scalping strategies perform under various market conditions? Scalping strategies are particularly effective in markets characterized by high liquidity and volatility. These conditions provide numerous opportunities for scalpers to capitalize on small price movements. However, in less volatile and illiquid markets, scalping can be more challenging. Scalping is most effective in markets with high liquidity and moderate to high volatility. These conditions provide the frequent price movements and tight spreads necessary for scalping to be profitable. Scalping may be less effective in very stable markets where price movements are minimal. What risk factors are involved in scalping strategies? The main risk factors in scalping strategies include managing frequent trades and dealing with rapid market movements. Due to the high volume of trades and the quick reaction times required, scalpers face risks related to execution, speed, slippage, and the stress of constant monitoring. Scalping involves a high number of trades, which can accumulate significant transaction costs. The primary risk is the potential for small losses to add up if many trades go against the scalper. There's also the risk of rapid market movements causing larger than expected losses. Scalpers need a strict risk management discipline, often using tight stop-loss orders to protect against these risks. What are the potential rewards of employing scalping strategies? The potential rewards of scalping strategies come from the accumulation of small profits over many trades. While individual profits per trade are usually small, the cumulative effect over a large number of trades can lead to significant gains. The reward potential in scalping lies in accumulating profits from many small trades. While individual profits per trade might be modest, the cumulative gain over many trades can be substantial. Scalpers aim for a consistent win rate rather than large profits from single trades. However, traders should be realistic about the net returns after accounting for transaction costs and potential losses. What considerations should be taken into account when implementing scalping strategies in futures trading? Key considerations for implementing scalping strategies include the ability to make quick entry and exit decisions, often based on technical analysis. Scalpers need to be highly disciplined, able to react swiftly to market changes, and must have a solid understanding of technical indicators and short-term price patterns. Implementing a scalping strategy involves several key steps. Identifying highly liquid futures markets with sufficient volatility. Using technical analysis tools like candlestick patterns, level 2 data, or short-term moving averages to identify quick entry and exit points. Setting precise entry and exit points, often with automated orders like limit orders for entry and stop loss orders for exit. Monitoring trades closely and reacting quickly to market changes. Considering factors like brokerage fees and market depth, frequent trading can lead to higher transaction costs. Scalping in futures trading requires fast decision making, discipline, and the ability to react quickly to market changes. Traders interested in this strategy should be prepared for the intensive nature of the trading style and have the necessary technical setup for efficient execution. Using momentum trading strategies in futures trading. Traders look for futures contracts that are moving significantly in one direction on high volume. They then take a position in the direction of the trend and aim to exit the trade when the momentum starts to fade. What are the objectives of momentum trading strategies in futures markets? The primary objective of momentum trading strategies in futures markets is capitalizing on market momentum. These strategies aim to identify and trade in the direction of strong market moves, seeking to profit from the acceleration in price movement. The primary goal of momentum trading in futures is to capitalize on assets that are experiencing significant directional movement. Traders using this strategy aim to identify futures contracts moving strongly in one direction, often driven by high volume, and take positions to benefit from this momentum. The focus is typically on short-term capital appreciation rather than long-term investment or income generation. How suitable are momentum trading strategies for different market conditions? Momentum trading strategies thrive in volatile and trending markets. These conditions are ideal for capturing significant price movements. However, in flat or range-bound markets, these strategies might struggle due to the lack of strong directional moves. Momentum trading strategies are particularly effective in volatile and trending markets where significant price movements occur. These market conditions provide the strong and sustained directional moves that momentum traders seek. This strategy may not be as effective in flat or range-bound markets where price movements are limited and lack clear direction. What is the risk profile of momentum trading strategies? The risk profile of momentum trading strategies involves managing risks associated with sudden trend reversals. These strategies can be vulnerable to quick and unexpected changes in market direction, which can result in rapid losses if not properly managed. While momentum trading can offer significant profit opportunities, it also comes with risks, particularly the risk of sudden trend reversals or market corrections. The maximum potential loss can be substantial if the market moves against the position and the trader fails to exit in time. Effective risk management strategies, including the use of stop-loss orders, are crucial for mitigating these risks. What rewards can be expected from momentum trading strategies? Rewards from momentum trading strategies can come from gains achieved during strong market moves. When markets show a clear direction, these strategies can capitalize significantly on the sustained momentum, leading to potentially high returns. The reward potential in momentum trading lies in capturing gains from substantial market movements. The best case scenario involves entering a trade at the early stages of a strong trend and exiting as the momentum begins to fade, thereby maximizing profit. However, traders should have realistic expectations, as not all identified trends will lead to large profits, and average returns will vary based on market conditions and timing. What are the key steps for implementing momentum trading strategies in futures trading? Key steps in implementing momentum trading strategies include identifying strong market trends and capitalizing on them. This involves using technical analysis to spot emerging trends, timing entries and exits effectively, and continuously monitoring the market for changes in momentum. Effective implementation of a momentum trading strategy in futures involves several steps. Identifying futures contracts with strong, sustained directional movement, often signaled by high trading volume. Utilizing technical analysis tools such as moving averages, trend lines, and momentum indicators like the Relative Strength Index, known simply as RSI, or the Moving Average Convergence Divergence, more commonly referred to as MACD, to confirm trends. Determining optimal entry points when a strong trend is established and setting exit strategies to capitalize on the momentum. Monitoring the trade closely for signs of momentum fading and being prepared to exit to protect gains or minimize losses. Taking into account factors like liquidity, contract expiration, and potential market moving events that could affect the trade. Momentum trading in futures requires a keen sense of market dynamics, the ability to quickly interpret technical signals, and the discipline to adhere to predetermined entry and exit strategies. Traders interested in this approach should be prepared for the fast-paced nature of this strategy and have the necessary risk management measures in place. Let's examine breakout trading strategies in futures trading. This strategy involves entering a futures contract when the price breaks beyond a predefined resistance or support level. Traders anticipate that the breakout will result in a significant price movement. What is the strategic goal of breakout trading strategies in the context of futures trading? The strategic goal of breakout trading strategies in futures trading is to capitalize on significant price movements. These strategies aim to identify and trade breakouts from established price ranges, capturing profits from the ensuing significant price moves. The primary goal of breakout trading in futures is to capitalize on significant price movements following a breakout from predefined resistance or support levels. This strategy focuses on capturing quick gains from sudden and substantial market moves, aligning predominantly with speculation and capital appreciation objectives. How do breakout trading strategies perform under various market conditions? Breakout trading strategies are ideal for volatile and transitioning markets. These market conditions often lead to strong price movements, providing opportunities for breakout trades. However, in less volatile or stagnant markets, finding genuine breakouts can be challenging. Breakout trading is most effective in volatile markets where significant price movements are more common. It is particularly suited to markets transitioning from periods of consolidation to new trends, as breakouts often signal the beginning of a strong market move in a specific direction. What risk factors are involved in breakout trading strategies? A key risk factor in breakout trading strategies is understanding and managing the risks of false breakouts. False breakouts occur when the price appears to break out of a range, but then reverses direction, potentially leading to losses. One of the main risks associated with breakout trading is the occurrence of false breakouts, where the price breaks a level but then reverses direction. This can lead to potential losses if the position is not managed correctly. The risk of rapid price movements against the position also requires vigilant risk management, often utilizing stop-loss orders to minimize potential losses. What are the potential rewards of employing breakout trading strategies. The potential rewards of employing breakout trading strategies come from profiting from strong market breakouts. When a true breakout occurs, it can lead to substantial price movements, offering the potential for significant profits. The reward potential in breakout trading comes from capturing the gains of a strong market move following a breakout. The best case scenario involves accurately identifying a genuine breakout and riding the subsequent price wave. However, traders should also be realistic about the average expected return, as not all breakouts will result in significant price movements. What considerations should be taken into account when implementing breakout trading strategies in futures trading? Key considerations when implementing breakout trading strategies include accurately executing the breakout strategy. This involves identifying reliable breakout points, setting appropriate entry and exit points, and using risk management tools like stop-loss orders to protect against false breakouts. To implement a breakout trading strategy effectively, traders should follow these steps. Identifying key resistance and support levels in futures contracts using technical analysis tools and historical price data. Monitoring these levels closely and waiting for a definitive price breakout. Entering the trade once the breakout is confirmed, either through increased volume or additional technical indicators. Setting an appropriate stop-loss order to manage risk, positioned just beyond the breakout point or based on a predetermined risk threshold. Determining exit points, either through preset profit targets or by monitoring price action for signs of reversal or loss of momentum. Considering factors like market news, economic events, and contract expiration dates that could influence market behavior and the success of the strategy. In breakout trading, quick decision-making and the ability to accurately interpret technical signals are crucial. Traders should be prepared for the fast-paced nature of this strategy and have a clear plan for both entry and exit to capitalize effectively on market breakouts. What about range trading strategies in futures trading? Here, traders identify stable high and low prices within which a futures contract is trading the range. They buy at the lower end of the range and sell at the higher end, capitalizing on the predictable oscillation of prices. What are the objectives of range trading strategies in futures markets? The objectives of range trading strategies in futures markets are to exploit price oscillations within a defined range. These strategies aim to capitalize on the predictable and recurring price movements that occur between established high and low price levels. The primary goal of range trading in futures is to profit from the oscillation of prices within a defined range. Traders identify stable high and low price points, forming a range, and aim to buy at the lower end and sell at the higher end. This strategy is typically aligned with income generation and capital appreciation through repeated short-term trades within the established range. How suitable are range trading strategies for different market conditions? Range trading strategies are most effective in stable, non-trending markets. In these market environments, prices tend to fluctuate within a consistent range, making it easier to predict and trade the upper and lower limits of the range. However, in strongly trending markets, range trading can be less effective. Range trading strategies thrive in markets that are stable and lacking a clear directional trend. In such conditions, prices tend to oscillate within a predictable range, making it possible to capitalize on these regular price movements. This strategy may not be effective in highly volatile or trending markets where price breakouts beyond the range are more common. What is the risk profile of range trading strategies? The risk profile of range trading strategies involves managing the risks of breakouts and sudden market shifts. The primary risk is that the market may break out of the range unexpectedly, leading to potential losses if the trader is not prepared to quickly adjust their strategy. The primary risk in range trading is the potential for a breakout where prices move beyond the established range, resulting in possible losses. Traders must be vigilant for signs of market shifts or breakouts and be ready to exit positions to minimize losses. Understanding the dynamics of the specific futures market being traded is crucial in assessing and managing these risks. What rewards can be expected from range trading strategies? Rewards from range trading strategies come from gains achieved through short-term price movements within the range. Traders can profit by buying at the lower end of the range and selling at the higher end, or vice versa in short selling scenarios. The reward potential in range trading lies in capturing profits from short-term trades within the established range. While individual gains from each trade might be modest, repeated successful trades can accumulate significant returns. Traders should set realistic profit targets and understand that the average return will depend on market stability and the accuracy of the range identification. What are the key steps for implementing range trading strategies in futures trading? Key steps for implementing range trading strategies include identifying well-defined ranges and executing trades in a timely manner. This involves analyzing historical price data to establish the range boundaries and using technical indicators to identify optimal entry and exit points within the range. To implement a range trading strategy effectively, traders should follow these steps. Using technical analysis to identify clear high and low price points that form a trading range in the futures market. Monitoring the range for stability and ensuring it has been tested multiple times. Entering buy positions near the lower end of the range and sell positions near the upper end, ideally using limit orders. Setting stop-loss orders just outside the identified range to protect against potential losses from breakouts. Keeping an eye on market news and economic indicators that might influence the stability of the range. Considering the futures contract's liquidity as well as expiration dates, which could affect the range's reliability. Range trading in futures markets requires a disciplined approach to both entry and exit points, as well as a keen understanding of market patterns and technical analysis. Traders should be prepared for the meticulous nature of this strategy and be adept at recognizing stable trading ranges and reacting swiftly to any signs of market changes. Let's examine pullback trading strategies in futures trading. Traders identify a strong trend, then wait for a temporary reversal pullback in the price before it resumes the original trend. They enter the trade during the pullback, expecting the price to continue along the trend. What is the primary objective of pullback trading strategies in futures trading? The primary objective of pullback trading strategies in futures trading is to capitalize on price corrections within a trend. These strategies aim to identify temporary pullbacks or retracements in a prevailing trend and enter trades that profit from the resumption of that trend. The primary goal of pullback trading in futures is to capitalize on temporary price reversals or pullbacks within an established strong trend. Traders aim to enter trades during these pullbacks, anticipating that the price will resume its original trend direction. This strategy is mainly focused on capital appreciation by leveraging short-term price movements for potential gains. How do pullback trading strategies adapt to different market conditions? Pullback trading strategies are particularly effective in clearly trending markets. They are designed to leverage the predictability of price corrections in a market that is showing a strong directional trend, either upward or downward. Pullback trading strategies are most effective in markets exhibiting clear and strong trends. These conditions provide identifiable pullbacks within a prevailing trend, offering entry points for traders. This strategy is less effective in range-bound or choppy markets where distinguishing a pullback from a trend reversal can be challenging. What is the risk profile associated with pullback trading strategies? The risk profile of pullback trading strategies involves managing the risks of misjudging trend continuation. There is a risk that what is perceived as a pullback could actually be the start of a trend reversal, leading to potential losses if the trend does not resume as expected. The main risk in pullback trading is misjudging the nature of the pullback, mistaking what could be a trend reversal for a temporary pullback. If the trend does not resume as anticipated, it can lead to losses. Traders need to use risk management tools such as stop-loss orders to protect their positions from adverse moves. What potential rewards can be expected from pullback trading strategies? The potential rewards from pullback trading strategies come from profiting from short-term trend resumptions. By accurately identifying pullbacks and entering trades at these points, traders can benefit from the subsequent continuation of the trend. The reward potential in pullback trading lies in capturing gains from the resumption of a trend after a temporary pullback. The best case scenario involves correctly identifying a genuine pullback within a strong trend and capitalizing on the subsequent trend continuation. However, traders should be aware that not all pullbacks will lead to profitable trend resumptions, and average returns will depend on market conditions and the trader's timing and strategy execution. What are the key steps and considerations in implementing pullback trading strategies in futures trading? Key steps and considerations in implementing pullback trading strategies include identifying pullbacks accurately and executing trades in a timely manner. This involves using technical analysis to spot potential pullback opportunities within a clear trend and determining optimal entry and exit points. Implementing a pullback trading strategy effectively involves identifying futures contracts with a strong and clear trend using technical analysis tools like moving averages or trend lines. Monitoring for temporary pullbacks in the trend using indicators like Fibonacci retracements, candlestick patterns, or RSI for potential entry points. Determining the optimal entry point during the pullback and setting up exit strategies, including profit targets and stop-loss orders. Being vigilant about market news and economic reports that could influence the trend's strength and the pullback's validity. Considering the contract's liquidity and expiration date, as these factors can impact price movements and trend sustainability. Pullback trading in futures requires a solid understanding of market trends, the ability to distinguish between a true pullback and a trend reversal, and the skill to execute trades swiftly and effectively. Traders should be prepared for the dynamic nature of this strategy and have the necessary risk management measures in place. How about counter-trend trading strategies in futures trading? This involves taking positions opposite to the prevailing trend in anticipation of a reversal. It's a riskier strategy as it goes against the market momentum, but can be profitable if timed correctly. What is the strategic goal of counter-trend trading strategies in the context of futures trading? The strategic goal of counter-trend trading strategies in futures trading is to capitalize on trend reversals. These strategies focus on identifying and trading against the prevailing market trend, aiming to profit from the points where the trend begins to reverse direction. The primary goal of counter-trend trading in futures is to profit from anticipated reversals in the prevailing market trend. This strategy is typically aimed at capital appreciation through speculation. Traders using this approach seek to identify potential turning points in the market, taking positions opposite to the current trend in expectation of a reversal. How do counter-trend trading strategies perform under various market conditions? Counter-trend trading strategies are ideal for potentially overextended markets where a current trend might be nearing its end. These strategies can be effective when a market shows signs of exhaustion after a prolonged trend, indicating a potential reversal. Counter-trend trading strategies are most effective in market conditions where a trend may be overextended and thus ripe for a reversal. This can occur in both volatile and trending markets. The strategy may be less effective in markets where trends are strong and show no signs of weakening, as the risk of misjudging the trend reversal is higher. What risk factors are involved in counter-trend trading strategies? There are higher risks involved in counter-trend trading strategies due to going against the market momentum. Predicting trend reversals can be challenging and carries the risk of entering trades prematurely if the prevailing trend continues longer than anticipated. Counter-trend trading is inherently riskier as it involves going against the prevailing market momentum. The primary risk is entering a trade too early before the trend actually reverses, which can lead to significant losses if the trend continues. Traders must have strict risk management practices, including tight stop-loss orders, to mitigate the potential losses from incorrectly timed entries. What are the potential rewards of employing counter-trend trading strategies? The potential rewards of employing counter-trend trading strategies come from profiting from the early detection of trend changes. If executed correctly, these strategies can yield significant profits by capturing the initial stages of a new trend. The reward potential in counter-trend trading lies in the ability to identify and capitalize on trend reversals before they become apparent to the majority of the market. The best-case scenario is accurately predicting a market top or bottom and entering a position that profits from the subsequent trend reversal. However, traders should understand that accurately timing reversals is challenging, and the average expected return can vary significantly based on market conditions and the trader's skill. What considerations should be taken into account when implementing counter-trend trading strategies in futures trading? Key considerations when implementing counter-trend trading strategies include accurately identifying reversals and effectively managing risks. This involves using technical and fundamental analysis to detect signs of a trend reversal and employing strict risk management techniques to minimize potential losses. Implementing a counter-trend trading strategy effectively involves Utilizing technical analysis tools such as oscillators like RSI or stochastics, divergence indicators, or reversal candlestick patterns to identify potential trend reversals. Carefully selecting entry points that signal a high probability of trend reversal while being aware of false signals. Setting precise stop-loss orders to manage the risk of the trend continuing against the position. Monitoring macroeconomic factors and market news that could influence trend stability and the likelihood of reversals. Being prepared for the psychological challenges of going against prevailing market sentiment and having the discipline to adhere to pre-planned entry and exit strategies. Counter-trend trading in futures requires a high level of market expertise, the ability to interpret technical signals accurately, and a strong risk management discipline. Traders should approach this strategy with caution, understanding its risks and rewards, and ensuring their trading style and risk tolerance align with the demands of counter-trend trading. Let's talk about volume analysis strategies in futures trading. Traders use volume data to identify potential trading opportunities. High volume can indicate the strength of a market move, either in a new trend or in a reversal. What are the objectives of volume analysis strategies in futures markets? The objectives of volume analysis strategies in futures markets are to utilize volume data to identify market moves. These strategies analyze trading volume as a primary indicator to confirm trends, detect reversals, or highlight the strength of market movements. The primary goal of employing volume analysis in futures trading is to utilize volume data as a key indicator for identifying potential trading opportunities. Traders use volume to gauge the strength and conviction behind market moves, whether they are initiating a new trend or indicating a possible reversal. This strategy is often used for both speculation and capital appreciation, as it provides insights into the momentum behind price movements. How suitable are volume analysis strategies for different market conditions? Volume analysis strategies are effective in both trending and reversal phases of the market. They can be used to confirm the continuation of a trend or to identify potential reversal points, making them versatile across various market conditions. Volume analysis strategies are versatile and can be effective in a variety of market conditions. High volume can signal the strength of a move in trending markets, confirming the sustainability of the trend. Similarly, in markets poised for reversal, an increase in volume can validate the potential change in direction. This strategy is particularly useful in volatile markets, where volume spikes can signify key trading points. What is the risk profile of volume analysis strategies? The risk profile of volume analysis strategies involves assessing the risks of misinterpreting volume signals. Misreading volume data or failing to corroborate volume signals with other indicators can lead to incorrect trading decisions and potential losses. The risk in volume analysis lies in the potential misinterpretation of volume signals. High volume does not always equate to a sustainable market move. It can sometimes be a result of temporary factors. There is also the risk of the market moving against the position if the volume analysis was based on incomplete or misleading data. It is essential to use comprehensive risk management strategies to mitigate potential losses. What rewards can be expected from volume analysis strategies? Rewards from volume analysis strategies can be gained from the accurate interpretation of volume trends. Correctly analyzing how volume correlates with price movements can provide valuable insights into market dynamics, leading to profitable trading opportunities. The reward potential in volume analysis comes from the successful interpretation of volume trends and acting on these signals before the majority of the market does. The best case scenario involves correctly identifying high volume movements that lead to significant price changes, allowing for profitable trades. However, traders should maintain realistic expectations, as not every high volume signal will result in a profitable market move. What are the key steps for implementing volume analysis strategies in futures trading? Key steps for implementing volume analysis strategies in futures trading include applying volume analysis in conjunction with other technical analysis tools. This involves understanding how volume changes relate to price movements, using volume indicators like the volume oscillator or on balance volume, otherwise known as OBV, and integrating this analysis into a broader trading strategy. Implementing a volume analysis strategy effectively in futures trading includes monitoring volume patterns alongside price movements using tools like volume bars or volume weighted average price, simply known as VWAP. Identifying significant increases or decreases in volume that may signal the start of a new trend or a potential reversal. Correlating volume data with other technical indicators for a more comprehensive market analysis. Setting up trades based on volume signals with clear entry and exit points, as well as predetermined stop-loss orders. Considering the impact of external factors like economic reports or market news, which can influence trading volume. Being aware of the contract's liquidity and the specific characteristics of the futures market being traded. Volume analysis in futures trading requires a nuanced understanding of market dynamics and the ability to interpret complex data sets. Traders employing this strategy should have a keen eye for detail and be adept at correlating volume data with other market indicators to make informed trading decisions. Let's talk about news and economic data trading strategies in futures trading. Involves trading based on news and economic reports that have the potential to cause significant market movements. Traders must be very quick to react, as the market's response to news can be immediate and volatile. What is the primary objective of news and economic data trading strategies in futures trading? The primary objective of news and economic data trading strategies in futures trading is to capitalize on market movements triggered by news events. These strategies aim to take advantage of the volatility and price fluctuations that often follow major news releases or economic data announcements. The primary objective of trading based on news and economic data in futures markets is to capitalize on the significant market movements that these events can trigger. This strategy is often oriented towards speculation and capital appreciation, as traders aim to leverage the immediate market response to news releases for potential gains. How do news and economic data trading strategies adapt to different market conditions? News and economic data trading strategies are highly effective in volatile and news-sensitive markets. They are particularly suitable for periods when markets are highly reactive to economic reports, geopolitical events, or any significant news that can impact market sentiment and prices. This strategy is particularly effective in volatile markets that are sensitive to news and economic data. Markets that react strongly to geopolitical events, economic reports, and corporate news provide fertile ground for this strategy. It is less effective in markets where such news has a muted impact or is already priced in. What is the risk profile associated with news and economic data trading strategies? The risk profile associated with news and economic data trading strategies involves navigating the risks of rapid and unpredictable market reactions. Markets can respond quickly and dramatically to news, and there is a risk that market movements may not align with initial expectations based on the news. The key risk in news and economic data trading is the market's rapid and sometimes unpredictable reaction to news, which can lead to significant price volatility. There is a risk of the market moving against the position if the news interpretation is incorrect or if market sentiment shifts unexpectedly. Quick reaction times and a solid understanding of market sentiment are essential to manage these risks effectively. What potential rewards can be expected from news and economic day trading strategies? The potential rewards from news and economic data trading strategies come from profiting from the accurate anticipation of news impact. If a trader correctly predicts how the market will react to a news event, they can position themselves to capitalize on the resulting market movements. The reward potential in this strategy lies in accurately anticipating the market's reaction to news and entering trades that align with this reaction. The best case scenario is a well-timed entry just before the news release, capitalizing on the immediate market movement. However, traders should be aware of the average expected returns and the fact that not all news will result in profitable opportunities. What are the key steps and considerations in implementing news and economic data trading strategies in futures trading? Key steps and considerations in implementing news and economic data trading strategies include effective execution of news-based trades. This involves staying informed about upcoming news events, understanding the potential market impact of different types of news, and executing trades quickly and efficiently in response to news releases. Implementing a news and economic data trading strategy involves staying informed about upcoming economic reports, news events, and geopolitical developments that could impact the markets. Using resources like economic calendars to track important release dates and times. Analyzing pre-release market sentiment and positioning to gauge potential market reactions. Quickly interpreting news outcomes and executing trades in response to the actual data versus market expectations. Setting predefined entry and exit points along with stop-loss orders to manage the high volatility and fast-paced nature of news-based trading. Being aware of factors like liquidity and the specific characteristics of the futures contract being traded. Trading based on news and economic data in futures markets requires traders to be well informed, quick to react, and adept at interpreting both the news and the market's response to it. A successful trader in this domain is one who can combine rapid execution with a keen understanding of market dynamics and sentiment. Let's discuss pivot points strategies in futures trading. Using pivot point calculations based on the previous day's high, low, and closing prices to identify potential support and resistance levels for the current day's trading. What is the strategic goal of pivot points strategies in the context of futures trading? The strategic goal of pivot points strategies in futures trading is identifying key trading levels for decision making. Pivot points are used to determine critical support and resistance levels, which can guide traders in making entry and exit decisions. The primary objective of using pivot points in futures trading is to identify potential support and resistance levels based on the previous day's trading data. This strategy is typically used for short-term decision making, aiding in speculation and capital appreciation. By understanding these levels, traders can align their trading strategies with the market's potential movement for the current day. How do pivot points strategies perform under various market conditions? Pivot points strategies are adaptable to various market conditions. They can be effectively used in both trending and ranging markets to identify potential turning points or areas where price movements might pause or reverse. Pivot points strategies are adaptable and can be effective in both volatile and stable markets. They provide clear, quantifiable levels which are especially useful in directional markets, helping traders to identify potential turning points or continuation patterns. However, their effectiveness can vary in extremely volatile markets where price movements are less predictable. What risk factors are involved in pivot points strategies? The risk factors in pivot points strategies involve mitigating risks with clear support and resistance levels. While pivot points provide structured levels, the challenge lies in correctly interpreting these levels and responding to false breakouts or unexpected market moves. The risk in using pivot points lies in the possibility of price movements breaking through these levels unexpectedly, leading to potential losses. However, the strategy provides a clear framework for setting stop-loss and take-profit orders, helping traders manage their risk exposure. Understanding how to interpret these levels in the context of prevailing market conditions is key to mitigating risks. What are the potential rewards of employing pivot points strategies? Key potential rewards of employing pivot points strategies come from gaining from accurate level-based trading. By accurately identifying and trading around these pivot levels, traders can capitalize on price movements between these points. The reward potential of pivot points lies in the successful anticipation of price reactions at these key levels. The best case scenario is accurately predicting whether prices will bounce off these levels or break through them, leading to profitable trading opportunities. However, traders should be aware that not every pivot level will result in a significant price reaction, and average returns will depend on market conditions and the accuracy of the pivot point calculations. What considerations should be taken into account when implementing pivot points strategies in futures trading? Key considerations when implementing pivot points strategies include applying pivot points effectively. This involves understanding how to calculate pivot points, integrating them with other technical analysis tools, and recognizing how price reacts at these levels in different market scenarios. Implementing a pivot points strategy effectively involves calculating the pivot point and support/resistance levels based on the previous day's high, low, and closing prices. Monitoring price action around these levels during the trading day to identify potential entry and exit points. Combining pivot point analysis with other technical indicators or chart patterns for a more comprehensive trading approach. Setting stop-loss orders just beyond the identified pivot levels to manage risk. Being aware of market news and economic events that could influence price movements and impact the reliability of pivot levels. Pivot point strategies in futures trading require a systematic approach and an understanding of how prices tend to behave around these key levels. Traders should be prepared to quickly adjust their strategies based on how the market reacts to these points, making it a dynamic and potentially rewarding approach for those who master it. What are some stock option trading strategies? Let's take some time to cover some of the strategies. Using covered call to speculate in stock options. This involves holding a long position in a stock and selling a call option on the same stock. The goal is to generate income from the option premium, especially in a flat or slightly bullish market. What is the primary objective of the covered call strategy in stock options trading? The primary objective of the covered call strategy in stock options trading is generating income through option premiums. By selling call options on stocks that the investor already owns, the strategy aims to earn premium income, supplementing the returns from the underlying stock. The primary goal of the covered call strategy is to generate income through the selling, otherwise known as writing, of call options on a stock that the trader already owns. This strategy is particularly geared towards income generation, leveraging the option premiums received as a source of earnings. It is less about capital appreciation of the underlying stock and more about earning from the options market. How does the covered call strategy perform under different market conditions? The covered call strategy performs optimally in flat or mildly bullish markets. In these conditions, the stock price is less likely to rise above the strike price of the call options, allowing the seller to retain the stock and collect the option premium. In strongly bullish markets, however, the potential for higher stock profits may be limited. Covered calls are most effective in flat or slightly bullish markets. In these conditions, the underlying stock is less likely to experience a significant increase that would lead to the option being exercised. This strategy is less suitable in strongly bullish or highly volatile markets, as the potential for the stock to rise significantly above the strike price increases, which could lead to the call option being exercised. What risk is associated with the covered call strategy? The risk associated with the covered call strategy involves balancing stock ownership and option risks. While the strategy offers premium income, there is a risk of the stock being called away if its price rises above the option's strike price. Additionally, if the stock price falls significantly, the premium income may not offset the capital loss. While selling a covered call limits the downside risk to the extent of the premium received, it does not eliminate the inherent risks of owning the stock. If the stock price falls significantly, the losses may far exceed the income received from the option premium. Additionally, there is an opportunity cost if the stock price rises well above the strike price, as the stock may be called away. What potential rewards can be expected from a covered call? The potential rewards from a covered call include regular income from premiums with limited capital gains. The strategy provides a steady income stream through the collected premiums, but limits the upside potential if the stock price rises significantly beyond the strike price of the call option. The primary reward of a covered call strategy is the income generated from the option premiums. This strategy provides regular income if the options expire worthless, allowing the trader to sell options repeatedly. However, the trade-off is limited capital gains on the stock. If the stock price rises above the strike price, the trader may miss out on these additional gains. What are the key implementation steps for a covered call strategy in stock options trading? Key implementation steps for a covered call strategy include selecting the right stock, choosing an appropriate strike price and expiration date for the call option, and executing the strategy by selling the call option while owning the underlying stock. Monitoring market conditions and managing the position as needed are also important aspects of this strategy. Implementing a covered call strategy involves holding a long position in a stock and having a thorough understanding of its performance and market trends, choosing the right call option to sell, typically one with a strike price above the current stock price and with an expiration date that aligns with the trader's income goals. Selling the call option and receiving the premium, which is income for the trader. Monitoring the stock and the market to manage the position, especially as the expiration date approaches. Being prepared to sell the stock if it exceeds the strike price or to buy back the option if market conditions change significantly. A covered call strategy in stock options trading requires a balanced approach, considering both the benefits of premium income and the risks associated with the underlying stock. Traders implementing this strategy should have a clear understanding of their income objectives, risk tolerance, and the market dynamics of the stock involved. Let's talk about protective put to speculate in stock options. In this strategy, an investor buys put options for a stock they already own. The put option acts as insurance, protecting against a significant drop in the stock's price. What is the strategic goal of the protective put strategy in stock options? The strategic goal of the protective put strategy in stock options trading is hedging against a decline in stock value. By purchasing put options, investors can protect their stock holdings against potential losses, effectively ensuring the value of their stock position. The primary goal of the protective put strategy is to hedge against potential losses in the value of a stock that an investor already owns. By purchasing put options, the investor gains the right to sell the stock at a predetermined price, thereby providing insurance against a significant drop in the stock's value. This strategy is focused on risk management and capital preservation rather than income generation or speculation. How does the protective put strategy adapt to changing market conditions? The protective put strategy is ideal for uncertain or bearish markets. In these conditions, the risk of a decline in stock value is higher, and the put options serve as a safeguard, offering protection against significant losses in the stock's value. Protective puts are most effective in uncertain or bearish market conditions where there is a risk of a significant decline in stock prices. This strategy is particularly useful for investors who want to retain their stock positions but are concerned about potential short-term downside risks. It may be less necessary in stable or strongly bullish markets where the likelihood of a significant drop in stock value is lower. What is the risk profile for a protective put strategy? The risk profile for a protective put strategy involves limiting downside risk with an added cost. While the strategy provides downside protection, the cost of purchasing the put options, otherwise known as the premium, is a guaranteed expense, reducing the overall profitability of the stock investment. The key risk associated with a protective put strategy is the cost of purchasing the puts, which can reduce the overall return on the stock investment. However, this strategy effectively limits the downside risk, as the put option sets a floor on the potential losses from the stock. The maximum loss is limited to the cost of the put option plus any decrease in the stock value up to the strike price. What are the potential rewards of using a protective put? The potential rewards of using a protective put include protection against losses with limited impact on gains. The strategy allows investors to retain the upside potential of their stock position while capping the downside risk, ensuring that losses do not exceed a certain level. The primary benefit of a protective put is the protection it offers against significant losses, while still allowing for capital appreciation if the stock price increases. The best case scenario is the stock price rises and the put option expires worthless, with the investor benefiting from the stock's appreciation. However, the cost of the put option will reduce the overall profit. What are the considerations for implementing a protective put strategy in stock options trading? Key considerations for implementing a protective put strategy include choosing the right strike price and expiration date for the put options, balancing the cost of the puts against the level of protection desired, and timing the purchase of the puts to optimize cost effectiveness. It's important to align the protective puts with the investor's risk tolerance and market outlook. Implementing a protective put strategy involves owning or purchasing a stock that the investor wishes to protect, identifying the appropriate put option to purchase, typically with a strike price at or below the current stock price, considering the expiration date of the put option, aligning it with the period during which protection is desired, purchasing the put option, paying the premium required, monitoring the stock and the put option, especially as the expiration date approaches or if market conditions change, deciding whether to exercise the put option if the stock price falls below the strike price or to let it expire if the stock price remains stable or increases. A protective put strategy in stock options trading requires a careful balance between the cost of protection and the desired level of risk management. It is a prudent strategy for investors who seek to mitigate downside risk while maintaining the potential for upside gains in their stock holdings. How about using bull call spread to speculate in stock markets? This strategy involves buying a call option and selling another call option with a higher strike price, but the same expiration date. It's used when the trader is moderately bullish on the stock. What is the objective of using a bull call spread in stock options trading? The objective of using a bull call spread in stock options trading is capitalizing on a moderate bullish market outlook. This strategy involves buying a call option at a lower strike price and selling another call option at a higher strike price, aiming to profit from a modest rise in the underlying stock's price. The primary goal of the bull call spread strategy is to profit from a moderately bullish outlook on a stock. It involves buying a call option with a lower strike price while simultaneously selling another call option with a higher strike price, both having the same expiration date. This strategy aims at capital appreciation by capitalizing on moderate upward movements in the stock price. How does the bull call spread strategy fare across various market conditions? The bull call spread strategy is most effective in moderately bullish markets. It is designed to generate profits when the market experiences a moderate increase in prices, but it may not perform as well in flat, highly volatile, or bearish markets. The bull call spread strategy is most effective in moderately bullish market conditions. It is designed to benefit from a steady but not explosive rise in the stock price. This strategy may not be as effective in highly volatile or bearish markets since significant price swings can undermine the controlled profit mechanism set up by the spread. What risks are involved in a bull call spread strategy? The risks involved in a bull call spread strategy are limited and defined. The maximum loss is the net premium paid for the spread. This is the cost of the long call minus the income from the short call. While the risk is controlled, the profit potential is also capped at a certain level. The risk associated with a bull call spread is limited to the net premium paid, which is the cost of the long call minus the income from the short call. The maximum loss occurs if the stock price is at or below the lower strike price at expiration. However, the strategy also caps the maximum profit at the difference between the two strike prices minus the net premium paid. What rewards can be expected from a bull call spread? The rewards from a bull call spread can be maximized gains within a specific price range. The maximum profit is realized if the stock price is at or above the strike price of the short call at expiration. The profit is the difference between the strike prices minus the net premium paid. The reward potential of a bull call spread is the difference between the strike prices minus the net premium paid. The best case scenario occurs when the stock price is at or above the higher strike price at expiration. However, traders should be realistic and understand that the maximum profit is capped, and the return on investment depends on the stock's price movement within the selected range. What key steps should be considered when implementing a bull call spread in stock options? Key steps in implementing a bull call spread include choosing the appropriate strike prices and expiration dates for both call options, assessing the cost of the spread versus the potential profit, and monitoring the underlying stock's price movement relative to the spread's break-even point. It's important to align the strategy with the investor's market expectations and risk tolerance. To implement a bull call spread strategy effectively, traders should identify a stock with a moderately bullish outlook, buy a call option with a lower strike price that aligns with the current bullish sentiment, simultaneously sell a call option with a higher strike price, ideally where the trader believes the stock price will rise but not exceed. Choose options with the same expiration date to create a spread. Calculate the net premium paid and understand the maximum risk, or the net premium and maximum reward, profit potential, which is the difference between strike prices minus net premium. Monitor the stock's performance and be prepared to take action if market conditions change significantly, affecting the outlook. A bull call spread in stock options trading requires a clear understanding of the stock's potential price movement and a moderate bullish market outlook. It offers a balanced approach with limited risk and controlled profit potential, suitable for traders who are bullish on a stock but not expecting dramatic price surges. Let's discuss bear put spread to speculate in stock markets. Similar to the bull call spread, but with put options. It involves buying a put option and selling another put option with a lower strike price. This strategy is used in bearish market scenarios. What is the primary objective of the bear put spread strategy in stock options trading? The primary objective of the bear put spread strategy in stock options trading is profiting from bearish market movements. This strategy involves buying a put option at a higher strike price and simultaneously selling another put option at a lower strike price, aiming to benefit from a decline in the underlying stock's price. The primary goal of the bear put spread strategy is to profit from a bearish outlook on a stock. This involves buying a put option at a certain strike price while simultaneously selling another put option with a lower strike price. The strategy aims for capital appreciation by exploiting expected downward movements in the stock price. How does the bear put spread strategy perform under different market conditions? The bear put spread strategy is ideal in bearish or declining markets. It is designed to generate profits when the market experiences a downturn. However, in bullish or flat markets, the strategy may not be as effective. The bear put spread is most effective in bearish market conditions or when the market is expected to decline. It allows traders to benefit from a drop in the stock price within a certain range. This strategy is less effective in bullish or highly volatile markets where the stock price is likely to rise or fluctuate significantly. What risk is associated with the bear put spread strategy? The risk associated with the bear put spread strategy is limited and defined. The maximum loss is restricted to the net premium paid for the spread, which is the cost of the long put minus the income from the short put. This makes it a controlled risk strategy. The risk in a bear put spread is limited to the net cost of the spread, which is the cost of the long put minus the income from the short put. The maximum loss occurs if the stock price is at or above the strike price of the long put at expiration. The defined risk nature of this strategy makes it attractive for traders who wish to limit potential losses. What potential rewards can be expected from a bear put spread? The potential rewards from a bear put spread are gains within a specific price range. The maximum profit is realized if the stock price is at or below the strike price of the short put at expiration. The profit is the difference between the strike prices minus the net premium paid. The reward potential in a bear put spread is the difference between the two strike prices minus the net cost of the spread. The maximum profit is achieved if the stock price falls to or below the strike price of the short put at expiration. However, traders should set realistic expectations, understanding that profits are capped and dependent on the degree of the stock's price decline. What are the key implementation steps for a bear put spread strategy in stock options trading? Key steps in implementing a bear put spread include selecting appropriate strike prices and expiration dates for both put options, calculating the net premium paid and the potential profit, and monitoring the underlying stock's price movement relative to the spread's break-even point. It's crucial to align the strategy with the investor's market expectations and risk tolerance. Effective implementation of a bear put spread strategy includes selecting a stock with a bearish outlook, buying a put option with a strike price reflective of the current market sentiment, simultaneously selling a put option with a lower strike price, determining where the trader expects the stock price to decline but not fall below, choosing options with the same expiration date to establish the spread, calculating the net cost or the premium paid for the long put minus the premium received for the short put to understand the maximum risk and potential reward, monitoring market conditions and being ready to adjust the strategy if the market outlook changes. A bear put spread in stock options trading offers a strategic approach for traders who expect a stock price to decline, allowing them to capitalize on this movement with limited risk. The strategy is suited for those seeking to benefit from bearish scenarios while maintaining control over potential losses. Let's discuss the straddle strategy to speculate in stock markets. A straddle is created by buying both a call and a put option with the same strike price and expiration date. This strategy profits when the underlying stock makes a significant move up or down. What is the objective of using a straddle strategy in stock options trading? The objective of using a straddle strategy in stock options trading is profiting from significant market movements in any direction. This strategy involves buying both a call and a put option with the same strike price and expiration date, allowing the trader to benefit from large price swings regardless of the direction. The primary goal of a straddle strategy is to profit from significant movements in the stock price, regardless of the direction. By buying both a call and a put option with the same strike price and expiration date, traders position themselves to capitalize on large moves either upwards or downwards. This strategy is often used for speculation, particularly in situations where high volatility is expected, but the direction of the market move is uncertain. How does the straddle strategy fare across various market conditions? The straddle strategy is most effective in highly volatile markets. It thrives when the market experiences significant movements, as large swings in either direction can lead to substantial profits. In contrast, in low volatility markets, where significant price movements are less likely, the strategy may not be as profitable. Straddles are most effective in highly volatile markets, where significant price movements are expected. This could be in response to an impending earnings announcement, economic report, or any other event that could lead to substantial market fluctuations. Straddles are less suited to stable markets where significant price movements are unlikely. What risks are involved in a straddle strategy? The risks involved in a straddle strategy include balancing the high cost of setting up the strategy, since it involves buying both a call and put option with the potential for unlimited gains. The break-even points for the strategy are further away due to the double premium cost, making it necessary for the stock to move significantly in either direction to realize a profit. The risk of a straddle strategy lies in the combined cost of purchasing both the call and the put options, which can be substantial. If the stock price does not move significantly, the trader may incur a loss equal to the total premiums paid for the options. However, the potential gain is unlimited on the call side and substantial on the put side, up to the strike price minus the premium paid if the stock goes to zero. What rewards can be expected from a straddle? The rewards from a straddle can include high gains if the stock moves significantly in either direction. The strategy's profit potential is theoretically unlimited on the call side and substantial on the put side, limited only by the stock reaching zero. The reward potential of a straddle is highest when the stock makes a significant move either up or down. The best case scenario is a sharp rise or fall in the stock price, well beyond the total premiums paid, leading to substantial profits. However, traders should consider the average expected return, factoring in the likelihood of significant price movements and the cost of the options. What key steps should be considered when implementing a straddle in stock options? Key steps in implementing a straddle include choosing a stock with potential for significant volatility, selecting the appropriate strike price and expiration date for both the call and put options, and timing the entry to coincide with expected market events or conditions that could trigger substantial price movements. Monitoring the market and adjusting the strategy as needed are also important. Implementing a straddle strategy effectively involves identifying a stock or asset likely to experience significant volatility, buying a call and a put option with the same strike price and expiration date. The strike price is typically chosen close to the current stock price, considering the cost of both options, as the initial investment can be significant. Monitoring market events and price movements closely, as timing is critical in executing profitable trades with straddles. Being prepared to act quickly following significant price movements to capitalize on the strategy's potential. A straddle strategy in stock options trading requires an understanding of market dynamics and the factors that can lead to significant price movements. It is a strategy best suited for traders who anticipate high volatility but are unsure of the market's direction, offering the potential for high returns at the expense of higher upfront costs. Strangle techniques to speculate in stock markets. Similar to a straddle, but the call and put have different strike prices. The strategy is profitable if the stock makes a large price move, but it typically has a lower upfront cost than a straddle. What is the primary objective of the strangle strategy in stock options trading? The primary objective of the strangle strategy in stock options trading is capitalizing on large market movements with lower costs compared to a straddle. This strategy involves buying an out-of-the-money, simply abbreviated as OTM call, and an OTM put option on the same underlying asset with the same expiration date, aiming to profit from significant movements in the stock price in either direction. The primary goal of a strangle strategy is to profit from large price movements in the stock, similar to a straddle, but with typically lower upfront costs. This is achieved by buying out of the money call and put options with different strike prices. The strategy is primarily used for speculation, aiming at capital appreciation in scenarios where substantial market volatility is anticipated, but the direction of the movement is uncertain. How does the strangle strategy perform under different market conditions? The strangle strategy is ideal for highly volatile markets. It is most effective when the trader anticipates a significant price movement but is unsure of the direction. However, in markets with low volatility, where significant price swings are less likely, the strategy may result in the loss of the premiums paid for the options. Strangles are most effective in highly volatile markets where significant price movements are expected. This could be due to major corporate events, economic reports, or other market-moving news. The strategy is less suited to stable markets where large price swings are unlikely, as significant movement is needed to overcome the cost of both options. What risk is associated with the strangle strategy? The risk associated with the strangle strategy is limited to the premiums paid for the call and put options. While the strategy offers potentially high rewards, the trader risks losing the entire premium paid if the stock price does not move enough to make one of the options profitable. The risk in a strangle strategy is limited to the total premiums paid for both the call and put options. If the stock price does not move significantly, the trader may incur losses equal to these premiums. However, unlike a straddle, a strangle requires the stock to move more substantially to become profitable, given the out-of-the-money position of both options. What potential rewards can be expected from a strangle? The potential rewards from a strangle include significant gains if the stock experiences large price swings in either direction. The profit potential is theoretically unlimited on the call side and substantial on the put side, up to the point where the stock price drops to zero. The reward potential with a strangle is high if the stock experiences a large price move, either upwards or downwards. The best case scenario is a significant surge or drop in stock price, exceeding the strike prices of both options, which can lead to substantial profits. However, traders should have realistic expectations about the likelihood of such movements and consider the average expected returns. What are the key implementation steps for a strangle strategy in stock options trading? Key steps in implementing a strangle strategy include selecting suitable strike prices for both the call and put options, which is usually out of the money, otherwise known as OTM, choosing the right expiration dates, and timing the trade based on market volatility expectations. It's also important to monitor market movements and adjust the strategy as necessary to manage the positions effectively. Effective implementation of a strangle strategy includes identifying stocks or assets likely to experience significant volatility, buying an out-of-the-money call option and an out-of-the-money put option, both with the same expiration date but different strike prices. Choosing strike prices based on the expected level of price movement and market analysis. Monitoring market events and price movements closely, as timing can significantly impact the strategy's effectiveness. Being prepared to act promptly following substantial price movements to maximize potential gains. A strangle strategy in stock options trading is suited for traders who expect dramatic movements in the stock price but want to reduce the upfront costs associated with a straddle. It requires a keen understanding of market dynamics and the factors influencing volatility, offering the potential for high returns with controlled risk. Let's discuss the iron condor to speculate in stock markets. An advanced strategy involving 2 put options and 2 call options with different strike prices but the same expiration date. This strategy profits from low volatility in the underlying stock. What is the strategic goal of the iron condor strategy in stock options? The strategic goal of the iron condor strategy in stock options trading is profiting from low market volatility. This strategy involves simultaneously selling a put spread and a call spread on the same underlying asset with the same expiration date. It aims to capitalize on the lack of significant price movement in the underlying asset. The primary goal of the iron condor strategy is to profit from periods of low volatility in the underlying stock. This strategy involves setting up a position that earns income from option premiums and is successful when the stock price remains within a certain range. It combines the sale of both put and call option spreads, making it a popular choice for income generation rather than capital appreciation or speculation. How does the iron condor strategy adapt to changing market conditions? The iron condor strategy is best suited to stable, low volatility markets. It performs well when the underlying asset's price remains within a specific range, not exhibiting significant movement. However, in highly volatile markets, the strategy can be at risk as larger price swings increase the likelihood of reaching the strike prices of the sold options. Iron condors are most effective in stable markets with low volatility. The ideal scenario is when the stock price fluctuates minimally and remains within a specific range. This strategy is less effective in highly volatile markets where significant price movements can breach the strike prices of the options, leading to potential losses. What is the risk profile for an iron condor strategy? The risk profile for an iron condor strategy is characterized by limited risk with a defined maximum loss. The maximum potential loss occurs if the underlying asset's price moves significantly beyond either the upper or lower strike prices of the spreads. This loss is limited to the difference between the strike prices of the spreads minus the premiums received. The risk in an iron condor strategy is limited and defined by the spread between the strike prices minus the net premium received. If the stock price moves outside the range of the strike prices at expiration, the maximum loss is realized. This loss is the difference between the strike prices of either the call or put spread minus the premiums received. What are the potential rewards of using an iron condor? The potential rewards of using an iron condor include income generation through the premiums received from selling the call and put spreads, with the gains being capped at the total premiums received. The maximum profit is achieved if the underlying asset's price stays between the strike prices of the sold options through expiration. The reward potential with an iron condor is capped at the net premium received from selling the option spreads. The best case scenario is the stock price remaining within the range of the strike prices, allowing all options to expire worthless and the trader to retain the full premium. However, the potential gain is limited to the premiums received, irrespective of how the market performs within the range. What are the considerations for implementing an iron condor strategy in stock options trading? Key considerations for implementing an iron condor strategy include choosing appropriate strike prices and expiration dates for both the call and put spreads, ensuring these strike prices form a range that the underlying asset is likely to remain within, and monitoring the market to manage the position as needed. The trader must also be prepared to take appropriate actions if the market starts moving towards either range's limits. To implement an iron condor strategy effectively, traders should identify a stock with low volatility and little expectation of significant price movement. Sell an out-of-the-money put spread, which entails selling a put and buying a put with a lower strike price and an out-of-the-money call spread. This means selling a call and buying a call with a higher strike price, both with the same expiration date. Choose strike prices that define the anticipated range of the stock price and consider the potential profit and loss scenarios. Calculate the net premium received, which is the income from selling the spreads, and understand the maximum potential loss. Monitor the stock price regularly to ensure it remains within the desired range, being prepared to make adjustments if market conditions change significantly. An iron condor strategy in stock options trading requires a precise understanding of market conditions and volatility. It is suited for traders seeking to generate income in stable markets, offering a balance between limited risk and capped potential gain. Careful selection of strike prices and diligent monitoring of the stock are crucial for the success of this strategy. Let's discuss the butterfly spread to speculate in stock markets. This involves using 4 options with 3 different strike prices. It can be constructed using either calls or puts and is designed to profit from a stock that stays within a narrow price range. What is the objective of using a butterfly spread in stock options trading? The objective of using a butterfly spread in stock options trading is profiting from minimal price movement in the underlying asset. This strategy involves combining both bull and bear spreads with the same expiration date, using either calls or puts to capitalize on a stock that is expected to have little to no significant price change. The primary goal of a butterfly spread strategy is to profit from a stock that remains within a narrow price range. This strategy involves using 4 options, either all calls or all puts with 3 different strike prices. It's designed to provide maximum profit when the stock price is close to the middle strike price at expiration. The butterfly spread is typically used for income generation, taking advantage of the premium decay as the options approach expiration. How does the butterfly spread strategy fare across various market conditions? The butterfly spread strategy is ideal in low volatility, stable markets. It performs best when the underlying asset's price remains close to the middle strike price of the spread. In contrast, in highly volatile or significantly trending markets, the effectiveness of the butterfly spread decreases. Butterfly spreads are most effective in low volatility, stable market conditions where significant price movement is not expected. This strategy thrives when the stock price remains near the middle strike price, making it less suitable for volatile or strongly trending markets where the likelihood of the stock price moving out of the target range is higher. What risks are involved in a butterfly spread strategy? The risks involved in a butterfly spread strategy are limited and defined. The maximum loss is restricted to the net cost of entering the trade, which is the cost of buying the spreads. This limited risk makes the butterfly spread an attractive strategy for traders seeking to control potential losses. The risk in a butterfly spread is limited to the net premium paid to establish the spread. The maximum potential loss occurs if the stock price is at or beyond either the lowest or highest strike prices at expiration. The controlled risk profile makes it an attractive strategy for traders who wish to limit their downside exposure. What rewards can be expected from a butterfly spread? The rewards from a butterfly spread include capped gains within a specific price range. The maximum profit occurs if the underlying asset's price is exactly at the middle strike price at expiration. The profit potential is the difference between the strike prices minus the net cost of entering the trade. The reward potential with a butterfly spread is capped and achieved when the stock price is near the middle strike price at expiration. The maximum profit is the difference between the middle and lower or higher strike prices minus the net premium paid. Traders should understand that the gains are limited to this range and set realistic expectations based on this understanding. What key steps should be considered when implementing a butterfly spread in stock options? Key steps in implementing a butterfly spread include selecting the appropriate strike prices and expiration date for the options involved, ensuring the middle strike is aligned with the expected price of the underlying asset at expiration, and monitoring the market to manage the position effectively. The trader needs to carefully plan entry and exit strategies to maximize the potential of the trade. Implementing a butterfly spread strategy effectively involves selecting a stock with low volatility and a stable price outlook, choosing 3 strike prices where the middle strike is near the current stock price, simultaneously buying 1 in the money and 1 out of the money option, and selling 2 at the money options, all with the same expiration date. monitoring the stock price to ensure it remains close to the middle strike price, being prepared to close or adjust the position if the market conditions change or the stock moves out of the desired price range. A butterfly spread in stock options trading is a sophisticated strategy requiring an understanding of options pricing and market behavior. It offers a balance between limited risk and potential gain, making it an appealing choice for income-focused traders who anticipate minimal movement in the underlying stock. Let's discuss the married put to speculate in stock markets. This is when an investor buys a put option for an equivalent number of shares they own in the underlying stock. It's a way of ensuring the value of the investor's holdings. What is the primary objective of the married put strategy in stock options trading? The objective of using a butterfly spread in stock options trading is profiting from minimal price movement in the underlying asset. This strategy involves combining both bull and bear spreads with the same expiration date, using either calls or puts to capitalize on a stock that is expected to have little to no significant price change. The primary goal of a married put strategy is to hedge or insure an investor's stock holdings against potential declines in value. By purchasing a put option for an equivalent number of shares they own, the investor secures the right to sell their stock at a predetermined price, thus limiting potential losses if the stock price falls. This strategy is focused on risk management and capital preservation rather than on income generation or speculation. How does the married put strategy perform under different market conditions? The butterfly spread strategy is ideal in low volatility, stable markets. It performs best when the underlying asset's price remains close to the middle strike price of the spread. In contrast, in highly volatile or significantly trending markets, the effectiveness of the butterfly spread decreases. Married puts are particularly effective in uncertain or bearish market conditions where the risk of a decline in stock value is high. This strategy provides a safety net, allowing investors to retain their stock positions while being protected from significant downside risks. It may be less necessary in bullish markets where the likelihood of a stock price drop is lower. What risk is associated with the married put strategy? The risks involved in a butterfly spread strategy are limited and defined. The maximum loss is restricted to the net cost of entering the trade, which is the cost of buying the spreads. This limited risk makes the butterfly spread an attractive strategy for traders seeking to control potential losses. The risk in a married put strategy is limited to the cost of the put option premium. If the stock price does not fall below the strike price of the put, the investor will incur the cost of the option without any offsetting benefit. However, the potential loss on the stock holding itself is capped at the put option's strike price, effectively limiting the downside risk. What potential rewards can be expected from a married put? The rewards from a butterfly spread include capped gains within a specific price range. The maximum profit occurs if the underlying asset's price is exactly at the middle strike price at expiration. The profit potential is the difference between the strike prices minus the net cost of entering the trade. The primary benefit of a married put is the protection it offers against significant losses, while still allowing for capital appreciation if the stock price increases. The best case scenario is the stock price rising, rendering the put option unnecessary, with the investor benefiting from the stock's appreciation. However, the cost of the put option will reduce the overall profit. What are the key implementation steps for a married put strategy in stock options trading? Key steps in implementing a butterfly spread include selecting the appropriate strike prices and expiration date for the options involved, ensuring the middle strike is aligned with the expected price of the underlying asset at expiration, and monitoring the market to manage the position effectively. The trader needs to carefully plan entry and exit strategies to maximize the potential of the trade. Implementing a married put strategy involves owning or purchasing a stock that the investor wishes to protect, buying a put option with a strike price at or slightly below the current stock price. The expiration date of the put should align with the period during which protection is desired. Paying the premium required for the put option, which is the cost of the protection. Monitoring the stock and the put option, particularly as the expiration date approaches or if market conditions change significantly. Deciding whether to exercise the put option if the stock price falls below the strike price, or to let it expire if the stock price remains stable or increases. A married put strategy in stock investing offers investors a way to protect their stock investments against significant declines while maintaining the potential for upside gains. It requires balancing the cost of the put option against the value of downside protection, making it a prudent strategy for risk-averse investors or in times of market uncertainty. The collar strategy to speculate in stock markets. A collar strategy involves holding the underlying stock, buying a protective put, and selling a covered call. It's a way to protect against large losses, but also caps potential gains. What is the strategic goal of the collar strategy in stock options? The strategic goal of the collar strategy in stock options trading is balancing risk management with capped gains. This strategy involves holding the underlying asset, buying a put option to protect against downside risk, and selling a call option to offset the put's cost. It aims to provide downside protection while accepting a limit on the upside potential. The primary goal of a collar strategy is to protect stock investments from significant losses while capping potential gains. This is achieved by holding the underlying stock, buying a protective put option to limit downside risk, and selling a covered call option to offset the cost of the put, which in turn caps the upside potential. The strategy is primarily focused on hedging against market movements and preserving capital, rather than aggressive capital appreciation or income generation. How does the collar strategy adapt to changing market conditions? The collar strategy is suitable for moderately bullish or stable markets. It works well when modest price increases are expected. However, large gains are capped due to the sold call. In bearish markets, the put option provides protection, limiting the potential loss. A collar strategy is most effective in moderately bullish or stable market conditions. It is designed to provide downside protection in uncertain or slightly bearish markets while allowing for some capital appreciation. This strategy is less beneficial in strongly bullish markets, as the sold call option limits the potential upside. What is the risk profile for a collar strategy? The risk profile for a collar strategy involves limited downside with capped upside potential. The strategy ensures that losses do not exceed a certain level. It's set by the put strike price, but it also means that any gains beyond the call strike price will not benefit the investor. The collar strategy limits downside risk to the strike price of the protective put, minus the cost of the put and any gains from the call premium. The primary risk is that the stock's price increases significantly, and the stock is called away due to the covered call, capping the potential gains. The investor's risk is balanced between the protection from the put and the limit on gains by the call. What are the potential rewards of using a collar? The potential rewards of using a collar include limited gains with downside protection. While the strategy limits the maximum profit that can be achieved due to the price paid for the call option, it provides a safety net against significant losses, making it a conservative strategy. The reward potential of a collar strategy is capped at the strike price of the covered call option. The best case scenario is the stock price increasing up to the call's strike price, allowing the investor to realize moderate gains while having downside protection. The cost of the put is often offset by the income from selling the call, but the overall profit potential is limited. What are the considerations for implementing a collar strategy in stock options trading? Key considerations for implementing a collar strategy include selecting appropriate strike prices and expiration dates for both the put and call options, ensuring they align with the investor's market expectations and risk tolerance. The strategy requires careful balancing of the cost of the put option with the income from the call option. Continuous monitoring of the stock and options prices is essential to adjust the strategy as market conditions change. Implementing a collar strategy involves holding shares of the underlying stock that the investor seeks to protect, buying a put option to set a floor for potential losses. The strike price of the put is typically at or below the current stock price. Selling a call option with a strike price above the current stock price, generating premium income that can offset the cost of the put. Choosing expiration dates that align with the investor's market outlook and risk tolerance. Monitoring the stock price and being aware of assignment risk on the call, especially if the stock price approaches or exceeds the call's strike price. Understanding the trade-offs between the cost of downside protection and the cap on potential gains. A collar strategy in stock investing is a conservative approach that balances downside protection with capped upside potential. It is particularly suitable for investors who are willing to forego some profit potential in exchange for reduced risk and greater peace of mind in uncertain or moderately bullish market conditions. Using the credit spread to speculate in stock markets. This involves selling an option, put or call, and buying a further out-of-the-money option of the same type. It generates income from the premium received, but has limited profit potential. What is the objective of using a credit spread in stock options trading? The objective of using a credit spread in stock options trading is generating income from option premiums with limited risk. This strategy involves simultaneously selling one option and buying another option of the same type, either calls or puts, but with a different strike price, resulting in a net credit to the trader's account. The primary goal of a credit spread strategy is to generate income through the premiums received from selling options. This involves selling either a put or a call option and buying a further out-of-the-money option of the same type, such as a put or call. The strategy is designed to capitalize on the premium differential between the sold and bought options, primarily focusing on income generation rather than capital appreciation. How does the credit spread strategy fare across various market conditions? The credit spread strategy can be effective in various market conditions depending on the type of spread used. A bull credit spread, which entails selling a lower strike call and buying a higher strike call, works well in rising markets, whereas a bear credit spread, which involves selling a higher strike put and buying a lower strike put, is suitable for declining markets. Credit spreads can be adapted to various market conditions. A call credit spread or a bear call spread is typically used in bearish or neutral market conditions, while a put credit spread or a bull put spread is effective in bullish or neutral conditions. The strategy is particularly useful in markets where the underlying asset is not expected to exhibit significant volatility beyond the strike prices of the options involved. What risks are involved in a credit spread strategy? The risks involved in a credit spread strategy include a limited maximum loss and profit potential. The maximum loss is the difference between the strike prices of the two options minus the net credit received, and the maximum profit is the initial credit received. The trader's risk is capped, but so is their profit potential. The risk in a credit spread is limited to the difference between the strike prices of the options minus the net premium received. This defines the maximum loss, which occurs if the market moves significantly against the position. However, the potential profit is also capped at the premium received for setting up the spread. What rewards can be expected from a credit spread? The rewards from a credit spread include income from premiums with capped gains. The trader earns the net premium received from setting up the spread, which is the maximum profit. This strategy aims to benefit from the time decay of options and the underlying asset's price movement in a favorable direction. The reward potential with a credit spread is the net premium received from the difference between the premiums of the sold and bought options. The best case scenario is where the underlying asset's price stays favorable relative to the strike prices, allowing the options to expire worthless, and the trader retains the full premium. However, the gains are limited to the initial premium received. What key steps should be considered when implementing a credit spread in stock options? Key steps in implementing a credit spread include choosing the right strike prices and expiration dates for both the sold and bought options, assessing market conditions to decide whether a bull or bear spread is more appropriate, and managing the trade to maximize the probability of keeping the premium received. Monitoring the underlying asset's price and being prepared to adjust the position as necessary are also important. To implement a credit spread strategy effectively, determine the market outlook to choose between a call or put credit spread. Select the appropriate strike prices for both the sold and bought options, ensuring the sold option is closer to the current market price. Choose options with the same expiration date to create the spread. Calculate the net premium received, which is the income from selling the spread, and understand the maximum potential loss and gain. Monitor the underlying asset's price movement and be prepared to manage the position, especially if the market moves towards the sold option's strike price. Be aware of assignment risk, particularly for the sold option as expiration approaches. A credit spread strategy in options trading requires careful selection of strike prices and a clear understanding of market direction. It offers a balance between income generation and risk management, making it a popular choice for traders seeking to profit from premium decay in a controlled risk environment. What about using debit spread to speculate in stock markets? Opposite of a credit spread, this strategy involves buying an option and selling another option of the same type but further out of the money. It requires an upfront cost debit, but can result in larger profits. What is the primary objective of the debit spread strategy in stock options trading? The primary objective of the debit spread strategy in stock options trading is achieving capital appreciation with controlled risk. This strategy involves simultaneously buying and selling options of the same type, either calls or puts with different strike prices, resulting in a net debit, which is the cost to the trader's account. The goal is to benefit from directional moves in the underlying asset while limiting the maximum risk. The primary goal of a debit spread strategy is to achieve capital appreciation while controlling risk. This strategy involves buying an option and simultaneously selling another option of the same type, such as a call or put, but with a further out-of-the-money strike price. The trader pays an upfront cost, typically a debit for the spread, but stands to gain larger profits if the market moves favorably. How does the debit spread strategy perform under different market conditions? The debit spread strategy is effective in directional markets, meaning it performs well when the underlying asset moves in the predicted direction, which is either upward for call spreads or downward for put spreads. Its effectiveness is reduced in flat or highly volatile markets where the direction is unclear. Debit spreads are most effective in markets with a clear directional trend, either bullish or bearish, depending on whether a call or put spread is used. A call debit spread is suitable in bullish markets, while a put debit spread is preferable in bearish markets. These spreads can benefit from market movements in the expected direction while limiting losses in unfavorable scenarios. What risk is associated with the debit spread strategy? The risk associated with the debit spread strategy is limited to the initial net debit paid to establish the spread. This limited maximum loss provides a controlled risk environment. The strategy does not expose the trader to unlimited losses, unlike some other options strategies. The risk in a debit spread is limited to the initial cost of setting up the spread, which is the net premium paid. This amount represents the maximum loss if the market moves against the position. The controlled risk nature of the strategy makes it attractive for traders who want to limit their downside while having the potential for higher returns compared to outright option purchases. What potential rewards can be expected from a debit spread? The potential rewards from a debit spread can be higher gains compared to the initial investment. The maximum profit is the difference between the strike prices of the options minus the net debit paid. This strategy can offer significant returns relative to the risk taken if the market moves favorably. The reward potential with a debit spread is typically higher compared to the initial investment. The maximum profit is the difference between the strike prices of the two options minus the net premium paid. The best case scenario occurs when the market moves favorably, allowing the trader to realize the full potential of the spread. What are the key implementation steps for a debit spread strategy in stock options trading? Implementing a debit spread strategy effectively involves selecting appropriate strike prices and expiration dates for the options, determining the direction in which you expect the underlying asset to move, and calculating the maximum profit and loss potential. It's important to monitor the trade closely and manage it according to market movements and the trader's risk tolerance. A good understanding of the underlying asset's price behavior and the impact of time decay on options is also crucial for successful execution. Implementing a debit spread strategy effectively involves analyzing the market to determine its direction and choosing between a call or put spread, Selecting appropriate strike prices for both the bought and sold options, ensuring the bought option is closer to the current market price. Paying attention to the expiration dates, ideally choosing options that align with the expected time frame of the market move. Calculating the net premium paid to establish the spread and understanding the maximum risk and potential reward. Monitoring the market closely and being ready to adjust or exit the position if market conditions change. A debit spread strategy in options trading requires a clear understanding of market direction and careful selection of strike prices. It offers a balance between risk management and the potential for significant returns, making it a favorable choice for traders with a specific market outlook and a desire to limit their downside exposure. As we conclude our comprehensive exploration of various trading strategies in both stock options and futures markets, it's important to take a moment to reflect on the key insights and takeaways. Our journey has taken us through a variety of strategies, ranging from the income-generating covered call to the protective married put in stock options trading. In the realm of futures trading, we have looked into strategies like trend following and pivot points. Each of these strategies serves specific objectives and operates optimally under different market conditions, each carrying its own unique risk profiles and reward potentials. Reflecting on the objectives and market conditions of these strategies is crucial. Remember, the primary goal of any trading strategy can be diverse, including income generation, capital appreciation, hedging against market movements, or outright speculation. The effectiveness of a strategy is deeply contingent on the prevailing market conditions. Some strategies are designed to thrive in volatile environments, while others are better suited for stable or directional markets. Understanding the risk and reward of each strategy is a fundamental aspect of trading. Every strategy comes with its potential risks, which include the maximum possible loss and the risk associated with movements in the underlying asset's price. It's essential to balance these risks with the potential rewards, which can range from the best case scenarios to average expected returns. Personalizing your approach to trading is arguably the most important takeaway. Your investment choices should be based not just on the strategies themselves, but also on your individual goals, time horizons, and risk tolerance. A strategy that works well for one investor might not be suitable for another, depending on their financial situation, market outlook, and personal comfort with risk. As you consider implementing these strategies, it's vital to think about the specific steps involved. This includes choosing the right strike prices and expiration dates for options or determining entry and exit points for futures. Also, consider any special skills required, such as technical analysis, for effective trading decisions. As we move forward from discussing strategies to making personal investment choices, it's important to reflect on your unique financial landscape. Consider your long-term objectives, the level of risk you're willing to accept, and the time you can dedicate to managing your investments. Successful trading is not just about selecting the right strategy. It's about aligning that strategy with your personal goals, your understanding of the markets, and your risk appetite. In summary, the art of trading and investing is as much about knowing yourself as it is about knowing the markets. As you ponder these strategies and their implications, consider how they align with your personal investment philosophy and how they can be tailored to fit your unique journey in the world of trading and investing. Navigating the complex world of trading and investing requires understanding the nuances of various strategies in both stock options and futures markets. As we conclude our extensive journey, we reflect on the diverse landscape of these trading strategies. We've explored a range of strategies, each with its unique characteristics and objectives suited for different market contexts. From the income-generating potential of covered calls to the risk management of protective puts in stock options, and from the market momentum strategies like trend following to pivot points in futures trading, each approach offers distinct pathways towards financial goals. Our exploration has emphasized that the success of any trading strategy is closely tied to specific market conditions and the trader's objectives. Whether it's income generation, capital appreciation, hedging against market movements, or outright speculation, aligning the chosen strategy with both market dynamics and personal investment goals is essential. Understanding the balance of risk and reward is central to this alignment, necessitating a careful evaluation of potential risks and expected returns associated with each strategy. Emphasizing the personalized nature of investment decisions, it's clear that trading and investing are deeply individualized activities. They require thoughtful consideration of one's own risk tolerance, investment horizons, and financial objectives. The right strategy for one investor may not be suitable for another due to different financial situations, market outlooks, and individual comfort with risk. When contemplating the implementation of these strategies, it's important to consider all practical aspects carefully. This includes not only selecting the right strike prices and expiration dates, but also a deep understanding of the nuances specific to each market. Special skills such as technical analysis play a crucial role in the successful execution of these strategies. As we look ahead, armed with a comprehensive understanding of various strategies and a clear grasp of personal investment philosophy, traders and investors are better equipped to navigate the complexities of the markets. The synthesis of strategic knowledge with personal insights forms a solid foundation for making informed and confident investment decisions. Successful trading and investing are as much about personal introspection and alignment with individual goals as they are about understanding the markets. Moving forward, it's important to carry forward the insights gained from this comprehensive exploration and allow them to guide you in making decisions that resonate with your unique financial narrative and goals. In the dynamic world of trading, a combination of knowledge, adaptability, and self-awareness are invaluable assets. Even though our discussion focused on speculating with futures versus stock options, did you know that there are also options on futures? In our exploration of stock options strategies, including covered call, protective put, and others, it's important to note that these approaches can also be relevant in the context of futures options trading. In future discussions, we plan to delve deeper into how these strategies can be effectively adapted and applied in the futures market. While the foundational principles of these strategies remain consistent, their application in futures options will require an understanding of the nuances specific to futures trading. This includes considerations like increased leverage, distinct margin requirements, and the characteristics of underlying assets in the futures market. We'll explore how the risk profiles and implementation steps of these strategies might differ when applied to futures options, ensuring a comprehensive understanding of their potential in various market conditions. This exploration will provide a more holistic view of the strategic options available to traders across different financial instruments and markets.